of LLP and taxation issues in LLP. And we have with us none other than our very own Anish ji. Anish ji is a person who has been dealing with such topics regularly, and we are thankful to Mohit Bhuturia ji who connected us with Anish ji and Nikhil ji, who will be deliberating on this topic. Requesting others to please mute themselves. And I request Rahul Parashampuria ji to please introduce our speakers for the day. Continue, Rahul ji.
Yes. Actually, I was not the host at that time. Yes. So thank you, President sir. I welcome Anish ji. So I would take an opportunity to read his profile, the speaker for the day. So Anish Thakkar, he is a fellow member of Institute of Chartered Accountants of India and a law graduate from Mumbai University. Has more than 3 decades of experience in income tax advisory, compliance, and litigation assignments. He is currently partner at Tax and Regulatory Services with SRBC and Associates LLP, looks after tax litigation and advisory. He has worked with BSR and Company and practiced in firm named AM Thakkar and Company. Was the president of the Chamber of Tax Consultants for the year 2021, member of the core group of Bombay Chartered Accountants Society and the Chamber of Tax Consultants. He has written various articles in newspaper, business magazine, professional journals, and online portals, and has also contributed papers and spoken at various seminars for professional bodies such as ICA, BCA, CTC, IFA, etc. And he has appeared on television as a guest speaker from business channels such as CNBC, TV 18, Bloomberg, NDTV, ET Now, CNBC Awaz, etc. So at the same time, I have also taken opportunity to introduce our second speaker, who will be taking on the second session. He is Mr. CA Nikhil Tiwari. He is a Director of Tax Regulatory Services of SRBC and Associates LLP. Being a member firm of EY Global based in Mumbai, he is a rank holder chartered accountant from 2007 batch and has more than 12 years of experience in handling direct tax appeal before various appellate forums and litigation advisory in field of corporate tax, international tax, transfer pricing for several multinational and domestic clients in a wide range of industry. He has been actively involved and is a regular speaker at internal as well as external forum, including ICAI, WIRC on technical and non-technical topics, Chamber of Tax Consultant, etc. He has co-authored various articles and publications on international tax and transfer pricing. So this was a brief introduction about Nikhil ji. We welcome Nikhil ji as well. So they'll be using a single system, I guess. So Nikhil ji is now on the screen with the name Anish Thakkar ji. Welcome Nikhil ji. So I think the first session will be taken by Anish ji. Over to Anish ji. He'll be dealing with the taxation issues with respect to the LLP, because currently the LLP is the most buzzword for the professionals, after the government having his eye on the LLP, after the companies at now it is the eye on the LLP. So LLP soon will be seeing the light of the day and has already started seeing the light of the day. So it was on the back foot. So over to our speaker, Mr. Anish Thakkar, who will take over the session.
Thank you very much, Rahulji, for the kind words of introduction. And it is my pleasure and my privilege to be addressing all of you today. This is, in a way, whenever there is a session like this, it is always a knowledge sharing session. It's an interactive session. So please feel free to post your questions in the chat box. Nikhil and I will definitely endeavor to answer all your questions to the extent possible. And it may also be that, we may not have all the answers. As, we all know, income tax is a very complex subject. It confused even the great Albert Einstein. So we are not, of that caliber for sure. And therefore, I would believe that as far as, answers are concerned, I'm sure we have views, but I don't know whether there are answers. And we'll look at some of the issues with regard to taxation of LLPs, and we'll see how there are only views and there are really no answers in that sense, because sometimes you have something which is completely patently unjustifiable, and but that's the way the law is written, unfortunately. Be that as it may, I think it is my privilege and my pleasure to be addressing all of you today. And I need to update my CV now to include ACAE in the list of organizations that I have been regularly speaking to, because I think this is not my first session, and I was very happy to be called our own, and then it gives me great pleasure to be called your own. It is, and I would believe that we are all bound by our quest for learning and for gaining more and more knowledge. So from that perspective, thank you very much for calling me your own, and I hope that I live up to the expectation that you have out of me. I am, as I said, joined by Nikhil. Nikhil is, and when Mohitji spoke to me, I said that you must get Nikhil onto this, because he is one of our very bright talents. And as far as the profession of tax is also concerned, when you hear him, you will see what a wealth of knowledge that he has. So from that perspective, it is my pleasure to be speaking along with Nikhil on this, and I welcome him also to this session. Now, coming to the subject proper, really let us look at a little bit of history as far as limited liability partnerships are concerned. And limited liability partnerships really originated in Italy, as a medieval European business model, followed by then other countries like France, Germany, Great Britain, US, Japan, etc. And in India, we may think that the concept is very, very new. But the fact of the matter is that way back in 1957, the Iron and Steel Hardware Merchant Chambers had suggested to the Seventh Law Commission that LLPs be introduced as a form of business organization. But unfortunately, the Seventh Law Commission at that point in time rejected it, thinking, and maybe rightly at that time, that it was too early for some sort of organization like a limited liability partnership, since we were just out of independence and we were trying to find our feet, and we had the Companies Act of 1956 just enacted. So from that perspective, I think it just got sidelined. And then the resurgence of LLP happened somewhere in 1997, where the Abid Hussain Committee for Small Scale Industries actually again recommended that LLPs be introduced as a form of business organization, particularly for the small scale sector. It was not till 2003 when the Naresh Chandra Committee report, where it was on regulation of private companies and partnerships, again highlighted this, that the concept of LLP was started to be taken seriously. And of course, the report by the J.J. Irani Committee in 2005 on company law, or whatever amendments were required to the Companies Act, actually paved the way for introduction of the LLP bill, which was introduced in Parliament on 15th of December 2006, which was assented to by the Union Cabinet, or approved by the Union Cabinet on 1st of May 2008. And on 21st of October 2008, the LLP bill was introduced in Parliament and was assented to by the President on 7th January 2009 and was notified on 31st March 2009. And if we see the origin of the LLP Act, it really owes its origin to the UK and the Singapore law as far as LLP is concerned, and it's loosely based on those two laws. Now, as far as one or two small things about LLP are concerned, really, as we know, the minimum number of members is 2. There is no limit to the maximum numbers, as we know that Section 464 of the Companies Act 2013, which is the parallel section to section 11 of the Companies Act of 56 restricts the number of members in an organization like a partnership to 50. But LLP is out of it, and therefore there is no limit to the number of members that an LLP can have. As far as taxation goes, and that is where we are here to discuss, I am sure that all of this has in some shape or form already been discussed. This is just trying to set the context. As far as taxation goes, really there are different ways in which how the world looks at LLPs. So there are countries like UK, Singapore, which look at LLP as a tax transparent entity. By a tax transparent entity, what we want to convey is that the entity per se does not pay any tax. It is only the members of the entity or the partners of the LLP that are taxed on their share of profit that they receive. The LLP itself is regarded as a flow-through entity. So again, when flow-through happens, which means that even if the partner does not receive the money, he will still be taxed on the income that the LLP earns. So per se, in a way, it is a check for distributions to happen, because nobody would want to pay tax out of his own pocket unless the LLP distributes money to him. And therefore, there is no plowback of reserves into the LLP, or at least to the extent of tax, certainly there is no plowback of reserves. What will happen and what normally does happen is that there's a distribution and then there is a call for capital contribution, which we see normally in many of the private equity type scenarios. There is also an opaqueness about the LLP in countries like India. For example, as we know, that we treat LLPs akin to partnerships. And therefore, in our country, the partnership itself is taxed and therefore the LLP itself is taxed. And any share of profit that the partner receives is exempt under section 10(2)(a). And this makes the LLP a good vehicle for capital repatriation outside of India, as we will see towards the end of, when I finish. But we will, just very briefly touch upon that. So Belgium, Australia, etc. tax the LLP on its own. And of course, there are countries like the US. The US always will be different from any of the other countries. So they tax LLPs based on a check the box system, where the partners of the LLP elect as to whether the LLP has to be taxed as a partnership or has to be taxed as a corporate. And if you tax it as a corporate, it becomes opaque. If you tax it as a partnership, it becomes transparent, where the partners actually pay tax. So there are check the box regulations as far as countries like US is concerned. If we turn the slide, be that as it may, I would believe that in India, we are opaque. And therefore, this is the way the LLP is taxed. There is a flat 30% tax. Surcharge varies depending on the tax depending on the turnover. So if there's a turnover of up to 1 crore, there is no surcharge. And if there's a turnover above 1 crore, there's a 12% surcharge with a maximum rate of tax for the LLP of 34.94%. As far as domestic companies are concerned, just as a comparison, if you opt for the concessional tax regime, then the maximum tax rate will come to 29.12% as we see. And if you do not, or if your turnover is more than 400 crores, then obviously you go out of the concessional tax rate regime and your maximum tax rate is 34.94% again. So at first brush, for most of us, we would believe that as far as taxation is concerned, a company may be more attractive. But if one looks at the cumulative incidence of tax, when a company does distribute dividend to its shareholders, the tax on dividend also gets factored into it, because the shareholder will ultimately receive money in his hands net of that dividend tax. Or in the good old days before dividends were taxed, there was a distribution tax, a dividend distribution tax that the company paid. And that tax again, effectively made the effective tax rate as far as the company was concerned about 42%, slightly more than 42%. And therefore, LLP in that sense is a more attractive way of business organization. Of course, there are certain inherent advantages of a company and there are certain inherent advantages of an LLP, which I believe is not the scope of the discussion today. So we will eschew that at this point in time. But my sense is that depending on the business requirement, an LLP should certainly be looked at as far as business organization is concerned, particularly as far as us professionals are concerned. An LLP is a very, very useful model of conducting our own profession, because liability becomes limited in today's day and age where, a lot of things are happening at a lot of places. My sense is that, it becomes a better form of organizing our own practices. Now, the LLP is also subject to what is called an alternative minimum tax under section 115 JC, where effectively after surcharge and cess, the effective tax comes to 21.55%, right? That's the minimum tax that an LLP will pay, as opposed to MAT in a company which goes to a maximum of 17.47%. Obviously, of course, we're comparing apples to oranges here. The reason for that is that the scope of MAT is far, far bigger as compared to the scope of AMT. And we all know that. And again, I'm not going to get into what is the base for computation of AMT and what is the base for computation of MAT. That's again not part of the discussion today. Suffice it to say that there is an AMT that is payable as far as an LLP is concerned. Moving on, Section 223 of the Act defines partner, partnership, and firm to include LLP formed under the LLP Act of 2008 and its partners. And therefore, as I had mentioned briefly, that an LLP is taxed in India as if a partnership would be taxed. And therefore, LLP and its partners again gets taxed similarly to a partnership firm and its partners, i.e. tax is levied at the collective level, and whatever distribution that a partner receives from that collective is not subject to tax in the partner's hands. Also, LLP is subject to the provisions of Section 184 that in order for an LLP to be assessed as a partnership firm, obviously you need to satisfy certain conditions, the conditions being that the partnership is evidenced by an instrument which you will anyway need as far as the formation of the LLP under the LLP Act is concerned, and the individual share of the partners are specified in that deed or that instrument of partnership. If Section 184 is not complied with, which I believe is slightly theoretical, but in a situation that it is not complied with, then obviously there is no deduction of interest, salary, remuneration, commission by whatever name called, while computing the income under the head profits and gains of business profession. So consequently, will be, relevant income from interest, remuneration, etc. should not be taxed in the hands of the partners because the LLP will pay tax on it. In today's day and age, when you have a very high surcharge for individuals, again, I would believe that no business sense emerges if you distribute in, remuneration or interest to a partner who is anyway paying maximum surcharge. So therefore, again, if you have partners in the highest tax bracket, the LLP, as far as protection is concerned and as far as tax is concerned, emerges as a very, very useful form of business organization, where you can limit your tax liability to 34.95% or 94% as the case may be, and also get protection as far as the partners are concerned in terms of them not having unlimited liability, as is the case in case of a partnership firm, where your personal assets can be attached. Here, your liability restricts itself to the amount of capital contribution that you make, exactly like a joint stock company. So I believe that, again, the LLP in that particular sense has the best of both worlds. Now, this deduction or non-deduction of interest and remuneration is restricted only to income under the heads profits and gains of business or profession. And therefore, if you have income from any other head, for example, house property, etc., then subject to your limit under section 24, my sense is that you should be able to claim the interest that you pay. But obviously, again, this would be a little bit of a moot proposition in view of what we just saw, that it may be better, particularly if your partners are taxed at the highest slab, to let the LLP bear the tax and not the partner. If the conditions of 184 are not complied with, the LLP gets taxed as an AOP. And also when an assessment under section 144 is made, then obviously the LLP does get taxed as an AOP, where you will have section 86 and section 67A come into play. And therefore, my sense is this is one more danger as far as the LLP is concerned, where, God forbid, if your assessment gets done on a best judgment basis, then you may have a challenge in terms of the higher tax liability that gets vested in an AOP. So you have to be careful when, of course, using LLP as a form of business organization, where you will need, to be clear that you would not want to let yourself lapse a little bit also when you do your tax compliance. Now, company, of course, includes an entity which is incorporated under the laws of a foreign country. And therefore, the question is that does an LLP, which is formed in a foreign country, for Indian tax purposes, does it get recognized as a company or not? The concept of incorporation depends on law to law. So, for example, if we see some of those state laws in US, for example, Delaware, there is no incorporation of an LLP under the Delaware law. It is just a formation or a constitution of an LLP. And therefore, in that situation, one would believe that the LLP would not be regarded to be a foreign company. So whether a foreign LLP for Indian tax purposes is a company or not will depend on one very crucial factor as to whether it is incorporated in that foreign country or not. And incorporation does not only mean, mind you, having a separate judicial existence from that of its members. Because even in India, the LLP has a separate judicial existence from its partners, but it is not incorporated and it is not a company, as we will see in some of the sections that we deal with later, that these apply only to companies and they do not apply to LLPs. And from that perspective, incorporation is a test that one will have to see under the local corporate law of that particular country or that particular state as far as the US is concerned. Now, how does the DTAA somewhere interplay with this? And the DTAA also has, in some cases, like for example, the UK, and we all would be aware of the decision of Linklaters, where you could have a situation where the LLP would be a different animal as far as the treaty is concerned. So therefore, one will not only have to look at the incorporation, one will also have to look at how the relevant treaty treats you as far as, you being a company or not for Indian tax purposes is concerned. Of course, if you are not a company, right, then the good part is that poem does not apply to you. And therefore, you don't have to test yourself on the grounds of your place of effective management. But if you see the residence criteria for LLPs or partnerships, then the test, I would believe, of residence is far, far stringent as compared to the test of poem. And the reason for that is that I would believe that if you see the criteria for residence of a partnership, the control and management of the partnership has to be wholly outside India for a partnership to be non-resident. And therefore, what would happen is that if that partnership has even some part and a very little part of its control and management within India, then that partnership would be resident in India. And therefore, when you are a foreign LLP, which is not regarded as a company, then you have to be very careful to see that no part of your control and management will be in India. Of course, control and management for Indian purposes is what is defined as your head and brain, right? See the decision of Mysore Petrochemicals, in 243 ITR, where it is said that the location of the head and brain of the company is what is more important, and not the day-to-day management and control. So it is the central management and control. Somewhere one may see that the theme around residence, whether it's a company or whether it's an LLP, remains more or less similar. But I could envisage situations, or we could envisage situations where you will have to have a little bit more nuanced test as far as an LLP is concerned. For POEM, at least there is a circular which gives you guidelines in terms of, if you do an active business, what is the test? And if you do not do an active business, what is the test? Moving on to the next slide, we see that as far as business income is concerned, right? Let us look at some of the provisions now as far as the domestic tax law is concerned in terms of what is applicable to an LLP and what is not applicable to an LLP. Now, question is that if an LLP pays interest to its partners, right, there is obviously a ceiling limit of 12% under 40B5 itself. And therefore, you will not get any deduction if you pay an interest of more than 12% per annum. The question really is that, is it something that you will need to test as far as 3613 is concerned, or is it something that you will leave as or is something that you will leave as not tested if 40B4 is applicable? Now, I would believe that 40B4 is a test itself. 3613 may or may not be looked at, because ultimately whatever a partner contributes by way of capital would normally be used by the firm for its own business activity. If, however, there is some divergence or some diversion of funds, then the test of 3613 may be looked at. My sense is that this is one controversy which somewhere still will come and bite us, that if there is a complete diversion of funds from the LLP, then what would be the situation? Can I rely on 40B4 and say that so long as I am paying interest at 12% per annum, then there should be no issue? And one needs to take oneself back to the decision of the Supreme Court in RM Chidambaram Pillai's case, 106 ITR 152, where the Supreme Court said that interest and remuneration are only different modes of distribution of profit to a partner, and therefore whatever is distributed to a partner is really it's akin to a distribution of profit. It is only a mode of distribution of profit. Taxation is a different animal. Tax will can create deeming fictions, but it is only a mode of distribution. So one will have to reconcile those two to be able to see where 3613 interplays with 40B4. In my view, if you ask me, Supreme Court decision still holds good, and you may have to look at 40B4 as a separate provision in itself. Now, salary, bonus, commission will only be paid obviously to working partners, nothing to non-working partners. Even if you pay to a non-working partner, it is not allowable as far as the deduction is concerned. There is a ceiling limit to remuneration, as we are aware. In case of a business, it is first 3 lakh, and then from the first 3 lakhs, 150,000 or 90% of the book profit, whichever is more. And the balance of book profit is 60%. And of course, 28(5) partners' interest, bonus, remuneration, etc. will be taxed in the hands of the partner. There is a specific provision under 28(5). No TDS required under 72 or any other section. Presumptive taxation 44 AD excludes LLPs, and therefore the question really comes as to what would happen under section 44 ADA. And if we move on to the next slide, then with effect from 1st April 2021, there is an amendment in 44 ADA which specifically excludes LLPs from the operation of 44 ADA. But before that, what would be the question? Would it be the case that you could get a LLP to compute or offer its income under 44 ADA, or would it be a case where 44 ADA would not apply? Now, if we see how the Ministry of Corporate Affairs treats the LLP, there was an office memorandum wide number CRC LLP forms dated 6th March 2009, which barred entities carrying on manufacturing and allied activities from adopting LLP as a business structure. However, this was reversed on 17th of April, and this restriction was withdrawn. So now effectively an LLP can carry out everything. But under the LLP Act, please remember that the LLP has to maintain books of account and get the books of account audited. So in that sense, if I look at it from that perspective, the operability of 44 ADA was never the question, because you would anyway maintain books of account and you would anyway get the books of account audited. The question only would be to get yourself audited under 44 AB or not is the question. And that's I would believe a question which is not significant. But 44 ADA, as far as the operation of that section from 1/4/21 is concerned, clearly LLP is not covered. This is only for the earlier part where one may want to rely on some of these arguments. Now, non-business income, which is credited to profit and loss account, should it also be part of the book profit as far as distribution or payment of interest or remuneration to the partners is concerned? And the answer is yes. There's a Calcutta decision in case of Sirajuddin where income accessible under non-business heads also was held to be forming part of the book profit. Despite there is a ceiling on the interest and remuneration, can the officer invoke section 48(2) and say that looking to the practice or looking to the market trend, the remuneration is excessive or unreasonable? The answer there again is no. And there's a decision of Great City Manufacturing of Allahabad High Court that ultimately 40B itself has a check which is built into it, and therefore you cannot bring in another check as far as 48(2) is concerned, because already there is a check inbuilt into it. Also, if we accept the Chidambaram theory that interest or remuneration is only a mode of distribution to the partners, then obviously this again makes sense, because ultimately what is it that you're going to achieve? Anyway, there are two other decisions that of the Bombay Tribunal and the Bombay High Court where it said that you cannot make a disallowance under 48(2) if there is a comparable cases available and there is no evasion of tax. I have given the decisions of Indo Enterprise and Indo Saudi. Both would be useful in case an officer were to invoke this. I don't think nowadays people are doing it, but this has happened, and stranger things will happen as far as this thing is concerned. Moving on. Now, one more question is that is a simple recital in the partnership deed that the partners can decide interest and remuneration on their own, subject to the limits of section 40B, okay or not. And there I believe the CBDT has taken a view in circular number 739 dated 21st March 1996, that is simple authorization for payment of remuneration, etc. in the deed is not sufficient, but it has to be specified in the deed, or the manner of quantification has to be laid down in that deed, and only then can working partners remuneration be allowed. In any case, I would believe that from the recent deeds, at least that I have seen, this is always specified now. Earlier we used to, for flexibility purposes, I still remember when this came in as a new provision way back in the 1990s, we were contemplating saying that we don't know how much remuneration we want to pay whom, and therefore we would keep it flexible such that we would remain within the overall ceiling limit, but inter se we may want to change. But I think now all of that is water under the bridge. Taking on the next topic in the next slide, as far as capital gains is concerned, there is a section 45(3) which says that if there is an introduction of a capital asset by a partner into the firm, right, it is chargeable to tax as capital gains in the year of transfer, and amount recorded in the books of account will be the full value of the consideration. So of course the taxation is shifted to when the asset is actually sold by the firm. But what is recorded as consideration in the books of account is the amount that gets credited in the books of the partnership firm into the partner's capital account. And the question that arises is that if there is immovable property that is introduced by way of capital, then can section 50C apply? And mind you, the question arises because 50C, it's a deeming fiction, where if admittedly there is a transfer of an immovable property, and if there is a transfer of an immovable property, 50C tells you that you have to take the stamp duty or the circle rate value for the sale consideration of that property. Now, there is also another deeming fiction in 45(3), which says that if there is an introduction of a capital asset into a partnership by a partnership firm, then what you will take as full value of consideration is the amount that is credited in the books of account. So there are two deeming fictions which apply. One is 45(3), one is 50C. Which one should apply? I would believe that the more specific one should apply and not the more general one. 50C is the more general one, 45(3) is the more specific one. And therefore, again, you have decisions which support that proposition, which is in Amartara and also in Amartara, basically saying that the deeming fiction under one section cannot be extended to another deeming fiction. So 45(3) being a deeming fiction in itself cannot extend itself to another deeming fiction in 50C. I would believe that dehorse that also. I would believe that the more specific provision is still 45(3). And in my view, therefore, the decision of Amartara has been properly and thoughtfully rendered. Now, question also arises is that if there is a capital contribution, does section 56 to 10 somewhere come into play? And this is again for asset in kind, because for asset in or for cash introduced, there should be no challenge. It is only for asset introduced in kind where can somebody say that there is a benefit which is received either by the firm or by the other partners by virtue of receiving an asset at less than an 11 UA value, and therefore 56 to 10 applies. There is a decision of Vasumati Prafulchand, Pune Tribunal, dated 2017. No 56 to 10 should apply. And also, of course, if we see our old decision of Sunil Siddharth by 156 ITR 509 Supreme Court, there the Supreme Court said that when an asset is introduced into a partnership by a partner, there is a transfer, but there is no consideration for that transfer. The consideration cannot be measured because it is in the womb of the future. Because what you get is a right to participate in future profits, and it is in the womb of the future. And therefore, there should be no question of any capital gains as the consideration cannot be determined. I think that is still something that holds good despite 50D, right? And this decision in Vasumati Fulchand somewhere also says that 56(2)(10) does not apply. 45(4) and 9B, obviously there is an entire section that is devoted to it. Suffice it to say that now if there is a reconstitution of a partnership and there is a realization by a partner in excess of any balance in its capital account, then the firm would pay capital gains, but the gains is computed again from a partner's perspective. There is a formula A is equal to B plus C minus D, where A is the capital gains, B is value of any money on the date of such receipt, plus C is the FMV of the capital asset on the date of such receipts, minus D is the capital account balance. So essentially anything over and above the capital account balance, whether it is by way of cash or whether by way of kind, if there is a receipt by a partner, it gets taxed as capital gains. The concept of transfer, unfortunately, is completely done away with. I will get Nikhil at the appropriate time to elaborate more on this, and a significant part of the presentation is actually devoted to this because we need to understand this far, far in detail. The point again being is that today, if you see the way the new 45(4) and 9B are actually drafted, and I will come in at the appropriate time when Nikhil is also discussing. But the point is that it seeks to do away with law which has been settled after years of litigation. It seeks to do away with the very fundamental concept of capital gains, where at least when I learned income tax, I was told that there is no capital gain which will arise in the absence of something called a transfer. And transfer was defined as whatever, sale, exchange, relinquishment, extinguishment of rights. And I was taught that Supreme Court says that on retirement of a partner, there is no transfer that happens. Unfortunately, the way the law has been written, and we will look at it in a very nuanced manner when Nikhil takes us through, is the fact that it has done away with all of this completely. It has just not, paid respect to any decision of the Supreme Court, any concept of transfer. You now have taxation at the point of receipt of a sum without there being a corresponding giveaway by somebody. And I think that is a little bit of a dichotomy that one has to deal with when we deal with this. Be that as it may, let us move to conversion of a company into a limited liability partnership. As we all know, there is a section 4713B, which basically lays down certain conditions for the conversion to be tax neutral. And those conditions are that all assets and liabilities immediately before the conversion becomes the assets and liabilities of the LLP. All shareholders immediately before conversion become the partners of the LLP in the same ratio as on the date of conversion. The ratio is a misspelling. Please apologize for that. The shareholders do not receive any consideration or benefit directly or indirectly in any form or manner other than their share of profit in the or capital contribution and capital contribution in the LLP. And this is important. We'll come to this in a little bit. The aggregate of profit sharing ratio of the shareholders in the LLP shall not be less than 50% at any time during the period of 5 years after the date of conversion. Total turnover in the 3 previous year preceding the previous year does not exceed 60 lakh rupees, and the total value of asset does not exceed 5 crore rupees. And no amount is paid directly or indirectly to any partner out of balance of accumulated profit standing in the accounts of the company on the date of a conversion for a period of 3 years from the date of conversion. So if you have accumulated profit or reserves sitting in the company, those reserves, at least for 3 years in the partnership or in the LLP, have to be retained in the books of the LLP. And the reason for that, I would believe, is that you should not be using this conversion only as a method of tax-free capital repatriation. Okay, and there are people who are creative. We will see what happens. Right now, there is a section 47A and subsection 4 of that 47A typically talks about what happens if these conditions are not satisfied. So if these conditions are not satisfied, obviously the conversion becomes a non-tax or non-tax neutral conversion, and the taxation will be in the year of the violation of the conditions. Now, if we look at this decision of Aravali, what had happened there was that we saw that there is one last condition in 4713B, which says that no distribution shall be made or no amount is paid directly or indirectly to any partner out of the balance of accumulated profit lying in the accounts of the company as on the date of conversion for a period of 3 years. In this case, what happened was that the partners of the LLP took interest-free loan out of this accumulated amount. And the argument there was that, look, there is no distribution, because distribution means something that is paid over to the partner without an obligation to repay. And therefore, there is no distribution. Distribution has a particular connotation and a particular meaning as far as the law relating to partnerships is concerned. And so long as I am not repaying somebody's capital, I'm just loaning him some money, it should really not qualify as a distribution. Tribunal negatived this. Tribunal said nothing doing. Again, there are provisions which says directly or indirectly. And what you are doing by way of grant of this interest-free loan is that you are allowing the person to use the money. The idea of the tax neutrality of 4713B is to let the money remain in the books of the LLP at least for 3 years, so that you don't use the conversion as a way to, or as a device to, get cash back into the hands of the partners or the shareholders. And here, by giving interest-free loans, you have actually done that. And therefore, the tribunal basically said that nothing doing. This, in the tribunal's view, amounts to a distribution, and therefore the condition of 4713B does get violated, and you have to be a little, the tax neutrality goes away. Now, I think that that is something which is important. One will always have to be a little careful on, whether you want to do something like this or not. In my view, it is better to let the amounts remain in the books of the partnership. Now, going back to the next slide, there are, what if the conditions of 4713B do not get satisfied? And we are all aware of the decision of the Bombay High Court in Texpin 129 ITR page 1, where a partner in conversion of a firm into a company was held not to be a transfer. And it was not held to be a transfer because ultimately you need two people for a transfer, one transferor and one transferee. In this case, under partner in the Bombay High Court held that it is the same person, albeit wearing a different cloak, right? It is the same entity constituted either as a company or as a partnership. The partnership cannot transfer something to itself. even though it gets reclassified or reconverted into a company. And therefore, there is no question of any capital gains being attracted. Now, the similar argument was sought to be canvassed as far as this decision of celerity power 174 ITD 133 was concerned. However, that contention was negatived by the tribunal to say that there is no transfer. The tribunal did say that there is a transfer. Okay. However, on cumulative conditions of A to F, which we saw of 4713B, there would be no capital gains. 47A4 comes into play only for the purpose of withdrawing an exemption earlier away, right? And capital gains involved in transfer of a capital asset on conversion of a private limited company to the SSC LLP. The whole applicability of 47A4 would be subject to liability of the SSC LLP as a successor entity under 170. However, what the tribunal interestingly held was that in this case, when the undertaking vested in the LLP, the entire undertaking of the transferor into inverted commas company vested in the transferee into inverted commas LLP, then it vested only at the book value. And if it vested at the book value, there is no mathematical capital gains that arise. And therefore, there is no question of payment of any tax as far as the individual or as far as the successor LLP or the transferor company is concerned. Because again, the question would be that the transferor LLP, transferor company is no longer in existence. So therefore, you would charge tax on the successor LLP as a successor to the business. And therefore, as far as the LLP was also concerned, there was no question of or payment of any capital gains tax. This decision, interestingly, because I think the taxpayer got what it wanted, a tax neutrality as far as the transfer was concerned, did not go into appeal. As far as I know, no appeal has been filed against this decision in the Bombay High Court. And therefore, today, my sense is that the whole question of what happens in case of a non-4713B compliant conversion is still open. We will have to see, what sort of views tribunals and courts take. Question is not of maybe capital gains in the hands of the company. The bigger question will come as to what will happen in the hands of the shareholders. And that is not addressed by celerity. That is not addressed by any decision right now. So one will have to wait to see what the courts hold as far as the existence or otherwise of a transfer is concerned. Because if indeed, as contemplated by celerity, there is a transfer, then it would also automatically imply, in my view, that there is a transfer by the shareholders to surrender their rights in a company to get a right in the LLP. Question again is, what is the value of that right in the LLP? Can it at all be valued? Can I take the argument of Sunil Siddharth Bhai and say that what I will get as future profit lies in the womb of the future? It is not possible for me to actually value that. However, I would believe that if I go and talk to people who are experts in the field of valuation, they say that they can predict on the basis of past performance of the company by way of some extrapolation of numbers, a value can be determined. Whether that value is scientific or unscientific is a different matter. But a value certainly can be determined. And therefore, can I therefore go back now to 50D and say that I can be, I can be subject to capital gains on the basis of that valuation under Section 50D of the Act? Those are open questions. I personally believe that, one will have to be very, very careful when one plans a non-4713B conversion of a company into LLP, particularly as far as real estate is concerned, because I would believe that the values are really, really significant. In any case, I believe this is not the last we hear of it. I am very enamored, if you ask me personally, by the no two people theory. Okay. And as far as transfer is concerned, again, 4713B or 45 does not talk about receipt like it talks about 45 or receipt in 45.4. So I have to have a transfer. And if I have to have a transfer, I need to have a transferor and I need to have a transferee. So I am quite enamored by the no two-person theory. But will courts be similarly enamored? I do not know. We'll see. I think, there is much to be seen and much to be heard as far as this is concerned. As we said, the amount of capital balance in or reserves in the company has to be retained in the books of the partnership for 3 years. It is better. You don't want to get into litigation at all. As far as some other implications of this conversion is concerned, depreciation on asset will be on the value of WDV that is available to the company. No step up in the WDV, JSW Steel Bangalore Tribunal. And we don't need that also, because I would believe that once we have a concept of tax neutrality, then there should be no challenge on claiming a higher depreciation. Proportionate depreciation as per 5th proviso to section 32(1) should be available. I'm aware I'm running a little, slow, so we'll try and speed it up a little bit. So proportionate depreciation between the transferor and the transferee. Other non-depreciable asset will be covered by 49(1)(3)(e), i.e. cost to the company, which is the previous owner. Amortization of VRS should be available as if no conversion has taken place. Again, 35 DDA 5 also, no amortization should be allowed to the converting company in the year of conversion. Balance should be allowed to your LLP after. Moving on, 40A1, 40A1A, 43B. In a compliant conversion, I believe that the successor entity should be able to claim the deduction. And here, I just want to highlight two decisions. One is the decision of the Supreme Court in J.H. Gotla's case, which is 156 ITR 323, which has been relied upon in a very recent decision of the Bombay Tribunal in Tata AIG General Insurance. The situation there was very different, mind you. The situation there was interpretation of Rule 5 of the first schedule, where Rule 5 of the first schedule says when you compute income of an insurance company which does not carry on life insurance business, whatever is allowed or disallowable under 30 to 43B should be disallowed. There is no provision for allowing the deduction in the year, subsequent year when the TDS has been paid or the amount has been paid as far as 43B is concerned. We are aware that as far as 43B is concerned, the Finance Act 21 had an amendment which was prospective to say that 43B deduction should be allowed to the insurance company in the year in which the actual compliance happens. But the question was that in an earlier year, what happens? And there, the Bombay Tribunal, very interestingly, in Tata AIG General Insurance, ITA number 1718 Mumbai 2020, dated 25th April 2022, decided that there cannot be a law which will, an interpretation of a law. There cannot be an interpretation of a law which can be completely unreasonable to a taxpayer. When the timing difference of 40A1, 40A1A and 43B is allowed to all other taxpayers, how can an insurance company, which otherwise is taxed similarly as compared to those taxpayers, be subject to an unfair treatment? And the tribunal therefore relied on Gotla's case and said that nothing doing, an interpretation of a law which results into a manifestly absurd interpretation cannot be accepted, and the law will have to be read down. The tribunal also relied on the explanation or the memorandum explaining the provisions of Finance Act 2021, where the amendment happened as far as 43B is concerned. But in my view, that interpretation is a secondary, or that reliance is a secondary reliance as far as the tribunal is concerned. The main thrust of the tribunal's argument always has been that the law cannot result in a manifestly absurd interpretation. And I would believe that as far as all these timing differences are concerned, when there is a conversion, albeit compliant or non-compliant, I would believe again, one will have to rely on these sort of decision to be able to canvass one's argument that one should not be deprived of those deductions just because there is a conversion, and particularly if one is convinced that the entity only changes clothes or cloaks. Explanation to 43.1. Of course, if deduction under 35 AD has been allowed or is allowable in respect to any capital asset to the predecessor company, cost shall be taken to be nil. 49.2 AA. Again, as far as the capital asset, which is the right in that partnership firm, is concerned, the cost of acquisition is the cost of shares in the company. Again, in spirit of the tax neutrality. And 72A, 72.7 A and B basically allow, in case of 47.13B compliant conversions, allow the carry forward of unabsorbed losses and allow also a fresh period of 8 years as far as the successor LLP is concerned. Okay. So, of course, this is only for 47.13B compliant conversions and not others. Other provisions, very quickly. Section 68, first proviso of source, not applicable to capital contribution as far as LLP is concerned. The reason for that is that it only applies to a company and share application. However, after the amendment, which is applicable from assessment year 2024, the aspect of proving source of loan or borrowing applies to all kind of taxpayers. So it will apply to the LLP as well. Capital contribution or a loan by a partner, in my view, is not loan or borrowing. And therefore, my personal sense is that as far as any loan from a partner is concerned, you should not be required to prove source. As far as return of income is concerned, the verification has to be by a designated partner. Of course, designated partner not being available, any other partner can sign. ICDS is applicable. 167C mandates each partner of the LLP to be jointly and severally liable to pay tax due of the LLP. If it cannot be recovered for LLP, of course, the liability will be restricted to the capital contribution of that partner in the LLP is concerned. Again, any 269 SS, 269T should not, I would believe, get attracted as far as, any, of course, in case of any company, any receipt or payment of fund from unsecured loans or in cash will attract disallowance. In case of LLP, partners can bring the capital in form of cash. Partners' capital is not a loan, as we saw. And various audits will obviously be applicable wherever, like any other taxpayer. 79 will not be applicable. 78 will be applicable, right? And, to the extent of change in constitution, if a partner retires, the proportionate loss will get disallowed just in case of as in case of a partnership firm. And liability of LLP partners as far as liquidation is concerned, proportionately liable, but to the extent of their capital. Again, I think, this is something which we will skip. 222 does not apply. Explanation 273 does not apply. As far as LLP is concerned, they apply to companies. And of course, there are certain benefits that are not available. I will share the presentation with you people and you can keep it. There's section 80 IAC also, where I have kind of put in what is applicable, what is not applicable. You all can read it. 14A, after the decision of Vishnu Anant Mahajan, will apply to share of profit of a partner in the LLP. Of course, in case of the share being a loss, there are these two decisions which say that 14A will not apply. Again, 269 SS will not apply. working partner can take remuneration for more than one firm, and if there is a survey and there is an income which is offered, can remuneration be paid from that income survey? The answer is yes. And again, there's a decision of the Pune Tribunal in Silver Place that we have put in. Now, I think I will skip this. I don't think there is anything. 41.1 is something that one will have to look at. Next slide also, I'm going to skip slide number 19. Repatriation of capital is what we promised we'll speak about. And I would believe that as far as repatriation of capital is concerned, particularly if and subject to foreign investors being allowed to participate in an LLP. So I'm placing a very big if here. It will be very attractive because there is no distribution tax. As far as domestic investors is also concerned, I would believe, again, it is very useful to note that LLP, we did note, is subject to a lower rate of surcharge. Distributions are not taxable in the hands of the partners, and therefore, as far as repatriation of capital is concerned, LLP is a far better structure. And as far as special economic zones is concerned, which is my last point before I let Nikhil take over on 45.4 and 9B. As far as SEZ is concerned, it does not specifically refer to LLP when the SEZ Act is concerned. However, the type of entities in the SEZ Act includes firm, AOP, etc. And since LLPs are also regulated entities, they are, I would believe, should be, there should not be any reason why the LLP should not be entitled to any benefit which accrues to it as far as having a unit in SEZ is concerned. In any case, practically, I would believe there should be no challenge. But in any case, one should always be careful and consider each aspect carefully when one does plan to set up an LLP in an SEZ. With that, I think I have taken up more than my quota of time. There is a lot to be covered by Nikhil in terms of section 45.4 and 9B. Let me hand it over to Nikhil to take this forward. Of course, I will come back at the end. I am very much around.
You are on mute, Nikhilji.
Yes. Thank you, Anish bhai. Thank you for nicely summarizing the entire tax angle of LLP, and thank you for nice introduction. We're learning from you. With this, I will start my presentation, wherein the topic allotted to me is taxation under section 9B and 45.4, which is newly inserted by Finance Act 2021. Before I go into this, I would just like to understand and debate slightly on how this amendment has been made, and whether this kind of amendment is first time being made, or this is the history which is happening from past. So the 45.4 in the current form and shape was not introduced in the Finance Bill 2021. The Finance Bill 2021 had 45.4, which was new 45.4, which was different than the what is happening in present 45.4, and there was 45.4A. These two sections were there. There was no section 9B when the bill was introduced. Thereafter, there is a memorandum which explains the rationale why this 45.4 came into picture. I will come to that. What was the memorandum? Why they have brought in new 45.4? But when the bill got enacted as an act, the 45.4, the form and shape was different. They have deleted 45.4A and they have introduced 9B, and they also changed 45.4. What was the reason why they have done that at the enactment stage? And if they have done that, what is the rationale? Because what we understand from the memorandum explaining Finance Bill 21 is something which is not there in the Act. And what is there in the Act? There is no rationale available in public domain which explains why they have brought two different sections, one in 9B and one in 45.4. Someone will ask, why it is making any difference? You just understand, read. The reason being, if you read both the sections together, there are so many questions which you will have. And if you read subsequently, there is some circular also wherein they, by section itself, they are empowered to issue that circular. I will also touch upon that. You get further confused. And if that is this, so you have to go by the intention. What is the intention? There is no document which provides the intention. Now you are in limine. What is to be done? With that background, let's understand whether this is first time they have done this. They have introduced something in the bill, and when it was enacted, that is totally different. It is not so. In the previous government also, when the present government was not there, they have done that. In my experience, I have seen sections like 56.2.7, 56.2.8, which was introduced in the bill, and what came in the enactment stage was totally different. In this government, last year only, when we were, last year as compared to 21, so 2020, when we were dealing with the COVID situation, they have enacted equalization levy 2.0 at the enactment stage. There was no such thing in the bill. So this practice is now growing, and there are many things which they want to introduce at the enactment stage. The only problem is we will not have the rationale or the speech of the minister on this and why they are doing this. With this background, I will take this. Again, before going into the actual section, what is this section and what is the language of this section? What controversies are creating because of the language in this section? Let's understand from which date it is applicable. It is applicable from 1st April 21, that is assessment year 21-22. Again, you are aware the second COVID wave came by end of March 21. It was there for 1.5 months. It went till May 21. This finance bill was passed on 28th of March 21. Then when the country was already struggling from COVID wave 2. So naturally, everyone has read this after the COVID was over in May 21, when the bill was, act was already enacted, because it came at the enactment stage. So you have time in May 2021 for reading all those things. In May 21, when you started reading, you came to know that, oh, this is already applicable from any transaction which is done from 1st April 20 till 31st of March 21. So you were doing your business wherein you were not aware of the law. Law came, which you were not aware at the time of actually entering the transaction. Again, this is not something new. This is the practice which was earlier following by earlier government also, this government also, for various sections. And again, the controversy arises whether this is somewhat retrospective amendment, even though for 1 year. Yes, it is retrospective amendment for 1 year. Yes, but this is there. Now, with this background, before going into my presentation, I would like to read the sections, how the section has been worded, and how this section is creating a controversy, and how, because of this, the earlier law and new law has created so difficult situation for the taxpayer. Now, there are section 45.4 and section 9B. I think everyone might have read in some or other form or shape this section and have understood this implication of this in their own way. I am going to discuss this at this stage because when I will go to my presentation, there are case studies and everything. For understanding that, we need to thoroughly understand what is this section at this stage. There are two sections, section 45.4, section 9B. I will first deal with section 45.4. Section 45.4 is substituting the earlier section 45.4. I am not going at this stage what was the earlier section 45.4 because there is already a chart wherein I will explain what is the difference between earlier 45.4 and new 45.4. So at this stage, I am skipping earlier 45.4. The 45.4 starts with notwithstanding anything contained in subsection 1. So the start itself says whatever happening in general 45.1 will not happen here. Whatever happening here is something over and above 45.1. And if that is happening here, you will not have to go to 45.1. Why I am discussing this? This has a very important thing to understand. When I will take the case study, I will explain why. This is the first non-obstinate clause in this section, but this is not the only non-obstinate clause in this section. There are so many other things, deeming fiction, non-obstinate clause in different form and shape. When I will read, I will explain what is the implication of that. Notwithstanding anything contained in subsection 1, where a specified person, now the specified person is already defined in section 9b, they have just imported here. Specified person in our context is LLP partners. Specified person receives. Now the entire controversy in this section will revolve around the word receives. During the previous year, any money or capital asset or both. So you have to receive during the previous year money, capital asset or both from a specified entity. The specified entity, again, it is defined in section 9b. That definition is imported here. The specified entity is partnership firm in connection with reconstitution of such specified entity. Now understand, who has to receive money and capital asset is a specified person, that is LLP partner from LLP. So that is the trigger event. But that trigger event has to be in connection with reconstitution. So now the point which will arise, if both the event has to be satisfied in the year in which you want to tax, or no, only receipt of money or capital asset is sufficient, even though the reconstitution is happening in the current year or not. That is the controversy. We will again deal this when we will go to the case study, because we have specifically taken the case study on this. Of such specified entity, then profit or gains arising from such receipt by specified person shall be chargeable to income tax as income of specified entity. Now here, the income will be chargeable to income tax as income of specified entity. The money and capital asset was received by specified person, that is a partner, but income will be chargeable to tax in the hands of LLP, that is specified entity, under the head capital gains, and shall be deemed to be the income of such specified entity. Now there the deeming fiction comes. This second or first deeming fiction of here, because it is actually the income of a partner, but you want to tax this as an income of LLP. So therefore you have deemed, shall be deemed to be the income of such specified entity for the previous year in which money or capital asset or both were received by the specified person. Now here, till here it is fine. Again, they have specified that it will be chargeable to tax in the previous year in which money or capital asset or both were received by the specified person. Now, what is this last phrase of this section 45.4? And notwithstanding anything to the contrary contained in this act, such profit or gain shall be determined in accordance with the following formula. Now, this is second non-obstinate clause in 45.4. First, this is anything, notwithstanding anything contained in subsection 1. So you don't look at subsection 1. This section will override subsection 1. Now here in the last phrase, they are saying notwithstanding anything to the contrary contained in this act. Now here they are overriding the entire act. They're saying whatever may be mentioned in the entire act, the profit and gain has to be computed in the following formula. So main clause of 45.4 has two non-obstinate clause and one deeming fiction. First, a non-obstinate clause is to override section 45.1 to say that 45.1 will not come for computation of capital gain. Second, for computation mechanism, they have override the entire act, and the computation mechanism in such a situation will be as per this section. And third, there is a deeming fiction to deem the income of partner in the hands of firm. Now, how to compute the capital gain? So at this stage, I am just concentrating on bare reading of section 45.4, how circular interpreting this, how rules has been incorporated basis this, I will come to later. This is in such a situation wherein you have given money or capital asset to the partner, the capital gain in the hands of firm has to be in the hands of LLP has to be computed in the following manner. A is the capital gain, B is the value of money, C is the fair market value of capital asset received, and D is the amount of balance in the capital account of the partner. So capital gain would be you add value of money plus fair market value of asset. There you will get the total of the amount which you have given. Then you have to reduce its capital balance, and the amount whatever you will get, that is the capital gain as far as the taxation of firm is concerned. Now, there is a proviso which says if entire effect of this section, rather this mathematical formula, is coming into negative figure, the value shall be taken as 0. Okay, so there will not be any question of loss in such a situation. If there is a loss, there will be nil capital gain. This is first proviso. Second proviso says when you compute the clause D here, that is a partner's capital account, for the computation purpose of partner's capital account, you have to ignore the revaluation of any asset or revaluation of any self-generated goodwill or self-generated asset. So while computing the partner's capital account balance, you have to only see the capital account balance, ignoring these two things: revaluation of any asset or any reserve credited due to valuation of or creation of self-generated goodwill or asset. Now, if you see this formula, if you read in the context of 45.4, 45.4 says income is deemed in the hands of firm in a previous year in which money and capital asset is given. So taxation will be in the year in which money or capital asset is given or reconstitution has happened. We have to understand that. I'm parking that issue aside. But how to compute the capital gain? If you read the clause D, it says the amount of capital balance in the capital account represented in any manner. Now, what is the meaning of represented in any manner? One natural meaning is if it is in the form of capital account, current account, any manner, you have to take that account. There could be another unintended meaning, which I will take when I will deal with this section in my case study. Of the specified person in the books of account of a specified entity at the time of its reconstitution. So capital gain will be chargeable to tax in the year in which the partner receives the cash or capital asset. But your cost of acquisition, which is there in this case, is the balance in partner's capital account that is to be seen at the time of reconstitution. So let's assume for a situation reconstitution is happening in year 1 and you are giving the cash or capital asset in year 2, 3, 4. Your D clause will not be computed on the basis of what is the value subsequently. Someone will say, how the value will change because he's retiring. No, here they are not only discussing about retiring. Reconstitution includes change in profit sharing ratio. So partner might be there. So, but you have to take the value of capital account as on the date when the reconstitution has happened. Next slide, please. Now, what is the meaning of reconstitution? This says take the meaning from the 9B. I am taking that meaning here because we are discussing 45.4 first. Now, reconstitution of a specified entity, they have given 3 things. Again, I have tried to understand clause B. I could not understand that in much detail, but I will explain what is the difficulty in understanding, but I will explain what is ABC. A says when one or more of its partner or member, as the case may be of LLP, ceases to be member. So that could be a 2 situation. Either you are retired or there is a death of the member. Second situation is one or more new members of the admission of the members. But the second condition is not stopping here. It says one or more new members admission in such LLP in such circumstances. Now the admission is further extended by way of a circumstances. In what circumstances? When your existing one or more member is still there in the LLP. I could not understand why they have given these circumstances. So let's assume a situation. If one or more partner is admitted to the partnership firm, but all other partner has been retired, or all other partner, or one partner died, or all other partner retired, LLP will continue. They will get caught in clause A because one or more partner ceases to exist. So what was the need for them to say that admission of partner or member in such circumstances? The further caveat by way of in such circumstances could have been avoided. Any admission, even if there is a existing member continues, not continues, you will get got into this. But they have given this. I don't know, in some future, someone might come with the litigation to say that if both conditions are not satisfied and I'm not falling in A and C, I'm out of reconstitution. I don't know why and when that will happen. I could not think of any such situation. But yes, this could lead to litigation in future. Now, third situation is if there is only change in profit sharing ratio. All other members or partners remains the same, but there is a change in the profit sharing ratio. This is a situation of reconstitution. So there is a slight change as compared to the earlier provision, where there was wording use was dissolution or otherwise, which court has interpreted in various different situations, which is otherwise will include retirement. But now, not only retirement, not only dissolution, they have also included admission. They have also included change in profit sharing ratio, which was otherwise not chargeable to tax in the erstwhile 45(4). Now, with this, I will again go back to 45(4) for completeness sake. Now, at this stage, whatever we have read in 45(4) on a standalone basis without going into 9B, we could not find any difficulty. Yes, if you are giving any money or any asset, you have to compute the capital gain in such a fashion. Okay, that is fine. There is no problem. Now the problem comes. Explanation 2. Now explanation 2 says, for the removal of doubts, it is clarified that when a capital asset is received by a specified person, that is a member, from LLP in connection with reconstitution of such specified entity, the provision of this subsection shall operate in addition to the provision of section 9B, and taxation under the said provisions therefore shall be worked out independently. So the explanation 2 says, for the removal of doubts. I don't know, and I will ask Anish Bhai to chip in that can the parliament come up with the explanation for the removal of doubts? So where is the doubt? First of all, there has to be some doubt. You have enacted this section first time in 2021 and you yourself are having a doubt. I don't know. If someone is having a doubt, this court is interpreting in some different sense, you can come with the explanation subsequently. So this is not my intention. My intention is something like this. So I'm giving a explanation to remove the doubts. Now the first time it is enacted, and the first time while enacting, they themselves are having a doubt and they are clarifying that doubt here. Okay, when I will hand over after the explaining bare provision to the Anish Bhai, let Anish Bhai explain if he has any experience in any such amendment that they have come up with this. Anyway, they say that 9B and 45(4) both will apply at the same point of time. I am taking much time here because if we go into case study, we will not understand unless we understand what is the nuances in the bare reading of this section. Now they say it will come together, it will apply together. 9B and 45(4) can go hand in hand, and capital gain can be computed under both the sections. So with this, now because 45(4) is under the capital gain chapter and it overrides 45(1), now we need to understand then what is 9B and under which head 9B is asking you to charge tax and under what circumstances. Now before going into 9B, two things we have to keep in mind. 45(4) only talks of reconstitution. Reconstitution in its ambit does not include dissolution. 45(4) talks of two kind of asset. One is money, second is a capital asset. Now with this background, I will move to 9B. Now 9B is forming part of chapter 2. Chapter 2 of Income Tax Act is basis of charge. Now when you say something you have amended in 45(4), 45(4) is charging section, because for in a capital gain there is a charging section 45(1). Then they have extended it by deeming it further 45(2), 2A, 3, 4 and all those things. So 45(4) is a part of charging section of capital gain, and they have given some deeming fiction in 45(4). That's fine. Now, when it comes to section 9B, under which head it falls, I don't know, because this is giving a basis of charge. So whether this basis of charge by in itself can be said to be a charging section for respective head of income, or this will only say that no, this is a basis of charge for each of the head of income, but there has to be separate charging section in each head of the income. Why I am saying so, again I will come. So this is forming part of basis of charge. Now section 9B starts income on receipt of capital asset or stock in trade by specified person from specified entity. This section introduced at the enactment stage says income on this is the I'm reading a heading of section 9B, which is not there at the screen. Income on receipt of capital asset or stock in trade by specified person from specified entity. So you have to receive capital asset or stock in trade. Unlike in section 45(4), there is a capital asset as well as cash, money. Here, capital asset is common in 45(4) and 9B, but in 9B there is a stock in trade, but there is no money. This is one change. Now I'm reading the section where a specified person, again specified person in the case will be member of LLP, receives during the previous year any capital asset or stock in trade or both from specified entity, again LLP, in connection with, again similar language as section 45(4). So your receipt of stock in trade or capital asset has to be in connection with dissolution or reconstitution. Now dissolution is added here, which is not there in 45(4), and reconstitution is there. So reconstitution and capital asset is two things which is common in 9B as well as 45(4). So vis-a-vis when there is a reconstitution and you are getting a capital asset, there could be implication in the 9B and 45(4). How that will arise, we will see. But if there is only dissolution, 45(4) will never come into picture. 9B only will come into picture. Or let's assume a situation if there is only distribution of stock in trade on account of dissolution, again it will 9B, or on account of reconstitution, again it will 9B. So if it is a stock in trade, you will never go to 45(4), will you come here. Let's assume a situation if there is a cash distribution on dissolution, you will be out of tax, because 45(4) talks of money, but it does not talks of dissolution. It talks of only reconstitution. But if you are giving money on account of reconstitution, you will caught under 45(4). But if you receive money under 45 and there is a reconstitution, you will go under 45(4). You will not come under 9B. There will not be any situation of double taxation or taxation under both the sections. So only at one situation, that is if you are giving a capital asset and there is a reconstitution. In that particular aspect, you will have to comply with section 9B as well as section 45(4). With this background, I will go further because I am reading this section and I just want to understand what all they are deeming here. As I explained in section 45(4), I want to understand 9B as well. In connection with dissolution and reconstitution of such LLP, then this member shall be deemed to have transferred such capital asset. Then the LLP shall be deemed to have transferred such capital asset or stock in trade or both, as the case may be, to this member in the year in which such capital asset or stock in trade or both received by specified person. Again, there is a deeming fiction which deems that there is a transfer of stock in trade or capital asset by a LLP. Now, I'm taking a pause here. We all know that there is a section called 247 which defines a transfer. Though they are deeming something as a transfer here in 9B, they are deeming something transfer as there in section 45(4), but they are not including this deemed transfer in section 247. Is that needed? Not needed? If that is not there, can you challenge that it is not transfer at all? If not transfer at all, you will be out of 9B and 45(4). This will be subject to litigation. We have to see how this develops, but there could be some scope. Again, there is some section called section 224, which defines income. You are giving a basis of charge here in 9B. There is no corresponding charging section as far as 9B is concerned in section 45. There is no corresponding charging section in profit and gains of business and profession as far as 9B is concerned. That presumes that you want to tax this basis of charge which you have given in 9B in somewhat which is there already in section 28 or 45, which we will deal how they might have contemplated. But at the same point of time, you have not included this in your income definition. If you have not included this in your income definition, whether I have to go further or I have to stop here, this is not income at all. If this is not an income at all, where is the question of going into specific charge section? If I can give you just one example, we all are aware, section 28, which is a charging section for business and profession, has in its embed various subsection which include subsidy by way of a duty drawback, DPP, any license, government subsidy, and all those things, which is there from 52, 67, 76, and from all those years. But there was no corresponding amendment in section 224, which they came with 2016. And there are courts who have earlier taken a view that if by nature of subsidy, you can substantiate that it is in the capital field, you will not be chargeable to tax, even though there is a basis of charge given, because basis of charge will only come into picture when if it is in the revenue field. So courts has allowed. But after amendment now, courts are taking a conscious view to say that because whatever will be the charging section, whether even if it is in the capital field, because now the capital account transaction has been included in the income definition, this might fall under the income definition. So they came with that in 2016 with prospective effect. At this stage, 9B or corresponding 45.4, because now they are deeming everything. The income is of a member, but you're deeming it in the hands of firm, but you're not defining that as an income in 224 definition, whether basis of charge and the charging section in 45.4 will itself have a good reason to charge you in that section without any amendment in 224 or in section 247, which is a transfer, which to my mind, it will be a litigative thing, and we have to see in future how advocates and chartered accountants are looking at this and arguing this before the various courts. I'm putting that here because at this stage, I don't want to give any answer because there is no answer. With this, let's come to subclause 2. Clause 1 is very clear of 9B. Now I'm going to clause 2. It says any profit and gains arising from such deemed transfer of capital asset or stock in trade or both, as the case may be, by LLP shall be deemed to be the income of such entity of a previous year in which some capital asset or stock in trade were received by the member. Now they are saying that it will be deemed to be the income, but that is not there in the definition of income. The clause 2 says chargeable to income tax as income of such LLP under the head profit and gains of business profession or under the head capital gain in accordance with provision of this act. So they are in a way trying to say that here I am just giving a basis of charge, but ultimately taxation will go under that section, and in that section and basis of that section, whatever the provision is there, you have to go and offer that amount for taxation. So far so good, but I want to just keep one thing highlighted here. I will deal that point when I will deal this case study. You say whatever capital gain we will compute here in 9B. If you read explanation 2 of 45.4, which says there can be both section going parallel. There can be capital gain under 9B basis of charge and capital gain under 45.4. In what section you will offer this capital gain of 9B? Because 45.4 says notwithstanding anything in 45.1. Now once 45.4 overrides 45.1, can by way of a backdoor entry of 9B, you have to offer on a same transaction capital gain under 45.1 read with 9B. That is something which I want you to think, and I will, when I will go through the case study, I will just discuss that and I will leave that point open. Now I am reading clause 3. For the purpose of this section, fair market value of capital asset or stock in trade, both on the date of its receipt by a specified person, that is member, shall be deemed to be the full value of consideration received or accruing as a result of such deemed transfer of a capital asset or stock in trade or both by the specified entity. Now this clause, they are deeming it as a full value of consideration. Why they are deeming? Because naturally this is income which was received by the member. Now you want to offer that as an income of a firm or LLP, then obviously you have to deem something. So they are deeming that fair market value of that capital asset or stock in trade will be deemed. Now again they are saying fair market value. They are not saying if we say a land situation 50C or any other value, this is in code in itself. They are saying fair market value. This is clause 3. After that, there is no further deeming. They are coming to clause 4.5. What is clause 4.5? I will come to in 1 minute. Where is the cost of acquisition in the entire 1, 2, 3? Actually, this is income of firm. This is income of member or partner. You want to deem everything in the hands of firm. You want to deem it is a transfer. You want to deem it is income of firm or LLP. You want to deem what is the full value of consideration. So where is the cost? You have to deem cost also. If we see the circular, they have conveniently said this will be the cost. But from where it is coming? If you are not deeming the cost and you are explaining in the circular that this will be the cost, they have deemed the cost as cost of that asset in the books of the firm. But how that will become? In the natural scheme of the 9B, you have never deemed what will be the cost of that thing. Just because it is charged to tax in the hands of firm or LLP, but it is income of partner or member, you are deeming everything else. You have to deem cost also. There is a lacuna which I feel, unless otherwise you deem a cost, there will be some intelligent officer who will say, I will not go to the circular, though I will, if I read 4 and 5, circular is binding on them, even binding on SSC, and what is the implication, I will come. But someone will say there is no deeming fiction to deem the cost. And if the cost, one reason I could feel why they have not deemed the cost, because cost is already sitting in the books of the firm. Still what? This is income of the partner which you want to tax in the hands of firm. If income of partner you want to tax in the hands of firm, the cost of firm will be given to the firm, but still you have to deem it. Unless you deem it, to my mind, there will be some problem. With this, now I will go to what is clause 4 and clause 5. Now it is again interesting. Clause 4 says, if any difficulty arise in giving effect to the provision of this section and subclause 4 of section 45, the board may, with the approval of central government, issue guidelines for the purpose of removing difficulty. Now, this section as enacted by Finance Act 21, assessments are still going on. SSC might have just filed the return. Assessment is not yet completed. 2nd July 2021, they have issued the circular after taking approval of the central government. So I just want to understand from them, and even I will read the circular, because after this I'm going to read the circular. Unless we read the circular, we will not understand what is their actual intent. And before reading the circular, I will also read the memorandum explaining the erstwhile 45.4, just before the act, what was introduced in the bill, how they have completely changed from the bill to act, and now what is their entire intention. Now it says, if any difficulty arise in giving effect to this provision, at this stage, neither any assessing officer has passed any order. This stage in the sense, on the date when they have issued circular, 2nd July 2021, neither any assessee has filed the return, because due date of filing return of income was still there. How they know that difficulty has arisen? If you are aware of such difficulty, why you have not enacted in this section 9B and 45.4 itself? I am not clear on this, and why at 2nd July 2021 they were enlightened with so much of difficulty, and then they have given so much example and everything, and whether that example and everything which they have given, whether it will fall in the true spirit of difficulty arises in giving effect to the provision of this section. I might be reading too much into this word of difficulty arise in giving effect to the provision of this section, but I have been trained like reading this in this way. Because if you go to the circular, they are saying to remove the difficulty and to provide clarification. Now, why you are providing clarification? No one has asked any clarification. If there is any difficulty in giving effect to this section, then only you have to give. That is the power given to you by this section. And if you give something more, that is extraterritorial or excessive delegation, and that should not be correct. That should not be valid. And why I'm saying so? Read section 5. Every guidelines issued by board under subclause 4 shall, as soon as maybe after it is issued, be laid before each House of Parliament and shall be binding on authority and on the SSE. Now, whatever you think by way of a circular or notification or guidelines which CBDT will issue will be binding on the SSE. Normally, whenever the guidelines of CBDT or circular is issued, the law is it is binding on the department, and if it is favorable, SSE will take the advantage of that. Otherwise, it is not binding on the SSE or the court. But here they say it is binding on the SSE. If it is binding on the SSE, why you giving so much of excessive delegation to them? Now, everything which is not even creating difficulty in giving effect to this section, they are clarifying, and they are clarifying something more, which is not there in the section 45(4) and 9(b). When I will read the circular, I will just highlight two such instances which I could think of. There could be various other situations. If we actually apply that circular in practical life, which we will think of, and then we will understand that they have given meaning of this even beyond that. Now with this, I will just take 2 minutes to read the memorandum explaining the Finance Bill 2021. I am not reading the erstwhile or the section 45(4) and 4A, which was supposed to be introduced by Bill 21, because it will create so much of confusion. I will just read the intention why they have introduced this 45(4) and 4A in the bill. The intention, I'm just reading 3-line paragraph, and I'm not reading the entire this thing. What was this thing? But why this section? In this regard, it has been noticed that there is an uncertainty regarding tax applicability of opposite subsection to a situation where assets are revalued or self-generated assets are recorded in the books of account and payment is made to partner or member which is in excess of his capital contribution. As you all are aware, in the erstwhile 45(4), that is prior to bill and act both, there are various judicial precedents which say that if you give something to the partner which is not over and above their capital account balance, and when you say capital account balance, it will include revaluation of all the assets at the time of retirement, then neither it is chargeable to tax in the hands of partner, nor it is chargeable to tax in the hands of firm, subject to satisfying the condition of section 45(4) if it is a capital asset which is distributed. Only that much levy was given. In all other situations, it was not chargeable to tax. Now, to overcome that was the basic intention, that we don't want to give the benefit of revaluation of assets or self-generated assets like goodwill or intangible assets while computing the capital account balance of the partner, and partner are enjoying that amount tax-free. This was the intention, and they wanted to tax that thing. But what they have done actually now in 9B and in 45(4) is something which is beyond this. Though I'm going slow, I'm taking much time. It's fine, because I want to complete this. And if you understand this, then all the case study is only cakewalk if we are through with this provisions. Now I will take the circular. I will ask my colleague Balak to share the circular on the screen. Circular is issued on 2nd July 2021. On the same date, there are two amendments in the income tax rules. Amendment 1 is in Rule 8AA, subclause 5 has been inserted. I will come to that. And second amendment is in Rule 8AB. The entire Rule 8AB has been inserted on 2nd July 2021. Now, if you see this circular, it says guidelines under 9B and subsection 4 of 45 of Income Tax Act. Paragraph 1, though not numbered as 1, it is paragraph 1. Subsequently, paragraphs are numbered at 2 and 3 onwards. 1 is just explaining what is the amendment. 2 is also explaining what is the amendment. So I'm not reading, because we have in detail understand the bare provisions of the Act. Paragraph 3 again explains the amendment. In paragraph 3, they are saying that clause 4 has given us the power to issue guidelines for removing difficulty. But they missed the subsequent word in section 4, difficulty in giving effect to this order. It says issue guidelines for the purpose of removing difficulty. They have stopped there. Okay, be the case as it may be. Let's go to the guidelines. Now, if you see the guidelines, it says guidelines before paragraph 4. Paragraph 4, 5, and 6. These are the guidelines. So actually speaking, even if we want to say that this has some force and binding, the thing which will be binding will be paragraph 4, 5, and 6. And thereafter, by taking help of paragraph 6, they have given various examples. I will just deal with what is paragraph 4. This is not very detailed, but I will deal. Actually speaking, the paragraph 4 is paragraph which was really required for giving effect, because there was some difficulty in giving effect of section 45.4. Now, as we read section 45.4, it says there could be double taxation under 9B as well as 45.4. Naturally, if there is a double taxation, there could be some kind of provision which would be there to give the cost step up. If I am charging something double at this stage, I will give benefit of that at subsequent stage. There is that section called 48 Roman 3, wherein they have said that if I am charging something double in the current year, I will give benefit of that subsequently. Now, the 48 1, I'm not discussing that what is double and everything, because I'm going to deal that. I'm just discussing what is the difficulty they have removed here. Now, if you see 48 1, 2, and 3, 48 Roman 3 is not 1, 2. 48 Roman 3, it talks of a situation wherein capital asset is not a depreciable asset. Because for depreciable asset, section 48 is not a section which comes into play for computation of capital gain. Section 50 or section 43 comes into picture. So in a situation wherein the capital asset, which is a depreciable asset, is given, how to compute the cost step up was not coming in the act. But they wanted, because there was a difficulty, in paragraph 4, they says the same meaning of 48 Roman 3 will be given in 50 or 43C. So to that extent, this is beneficial provision to avoid the double taxation in the case of depreciable asset. And this one could really say that, yes, this is what something they have explained, or they have clarified the difficulty which could have arisen in giving effect to 45.4 or section 9B. So I have no problem as far as paragraph 4 is concerned, and it is in the favor of SSC, and it is, in fact, it was needed. Now comes paragraph 5. Paragraph 5 says, for the removal of doubts. Now, I'm asking myself, who has given them the power to issue a guidelines for removal of doubts? First of all, in 45.4 explanation 2, you says for removal of doubts. How many doubts you have? I don't know how many doubts they have. First, they clarify one doubt by enacting that doubt in the act itself. Now they still feel there are some more doubts. Who has doubts? Department has doubts. We don't have any doubts because as of now, we have not even implemented this section. Now they're clarifying their own doubt, and their own doubt is binding on the SSC. But that clarification of their own doubt, it to my mind is beyond section 45 9B4. Now this is for removal of doubt. It is further clarified that in a case of capital asset remaining with specified entity is forming part of block of asset, the amount attributed to such capital asset under Rule 8B of the rule shall be reduced from the full value of consideration received or accruing as a result of subsequent transfer. They say in first situation, wherein I says in para 4 they are giving some benefit. This is that benefit, how to compute the capital gain. So for to the extent of double taxation amount which has been derived, when you are selling the depreciable asset subsequently in future from the full value of consideration, the amount of tax which you have doubly offered in this year has to be reduced. Okay, fine. By way of paragraph 4, it was very much clarified. There was no doubt, but still they had doubt, they clarified. Now, interestingly, this comes, paragraph 6, where I have a serious concern. Now, this is for the purpose of understanding and for removing difficulties. Again, this is beyond 4. If you want to understand something, you understand. And if you want to understand that and you want to guide your officer, you guide them. that understanding cannot be binding on me under 9B, 4 and 5, because that says it is binding on the SSC. And that understanding you are explaining and saying binding on the SSC. Nevertheless, that is the thing. Is saying for the understanding and removing difficulties. I don't know what difficulty it was there. If any, the application, if any. Now, there was no difficulty as such. They feel that there could be a difficulty or could arise if any. They are giving example 1, 2, and 3. Frankly speaking, to my mind, this example 1, 2, and 3 could have given along with this explanation in the memorandum explaining the Finance Bill 2021, when they could have enacted both the section at first stage itself. Just because they have missed the bus, they were not clear. Why was the hurry? They could have very well enacted or resubstituted that in 2022 Act, but they have not done that. They have taken a backdoor entry, and everything is now binding on the SSC. Otherwise, this could have been by way of a circular as a memorandum explaining, which could have been only used if there is any doubt, and that could have not been binding on the SSC. But nevertheless, the backdoor entry says it is binding on the SSC. Their doubts, they are removing difficulties, their intention, everything is now binding on this. Now they have given the 3 examples. Before I go into the example, I will just, because I have taken the case study, which is a simpler version of this example. So I will go to the case study. If I take this example, it will be a little bit confusing. But because I said at 2 places I could find there could be a situation wherein whatever they are writing here is not coming out of the entire scheme of the Act. And that 2 situation I will explain when I will explain my case studies, so that it will be on this certain facts, it will be clear that what I'm talking. Otherwise, it will not make any sense. Now they have just, I will explain, they have given the 3 examples. Example 1 and example 2 is really speaking a situation wherein they are talking of how the current provision will come into picture and why they are charging a double taxation under 45(4) and 9B. This they are saying in example 1. And in example 2, they are saying that if the transaction of giving the capital asset to the partner, if rather than giving that capital asset to partner, I have given it to the, I have sold it to the third parties, and only I would have given the cash to the retiring partner, what could have been the capital gain tax which would have been paid by the firm would be the same, which we are now trying to achieve by way of this amendment. So in example 1, whatever the capital gain tax amount comes, wherein the capital asset is distributed on retirement of the partner or member. In example 2, they are giving a stamp that we are not charging anything extra. If this you could have sold to third party and only given the cash to the partner or a member, this would have the same amount of tax which you would have been paid. Now again, I am not clear on this, because if I see the example 1 itself, they have assumed so many things. They've gone even beyond the basic concept of accounting, and they say how you have to account as far as partners capital, writing of partners capital account is concerned. This could not come in any way as a binding thing by taking help of section 9B4, but they have taken that. I will take that how they are reading this when I discuss my case study, because my case study is simpler, and then I will jump to this case study when I will discussing my case, so things will be very much clear. In case example 3, they have just explained. The example 3, in fact, is given after explaining example 1 and 2, that how the scheme of thing is there. They have given this example to say how we will compute the cost step up to avoid the double taxation, to say that I am giving you a fair opportunity, there will not be any double taxation. So they have given that example. Again, because I have already taken in my case study, I am not discussing this case study. Again, here also I have serious problems, because whatever they are writing here, if you truly go with the language of this section, they will not be even able to match that. Be that as the case may be, they have given this, which is at this stage binding on this. Now with this, I will come to 8AA and 8AB rule, which has been inserted on the same date. And what is this rule? I will briefly explain the rule, but because if I take the case study, there this rule will automatically come into picture, then I will discuss in detail. Rule 8A is basically talking of a situation that, because now what we are talking of a charging of a capital gain under 45(4) and capital gain or business income under 9B. So there could be one question of what is the nature of capital asset, whether it is a long term or short term. They have specified that what could be the long term and what could be the short term. They are saying three situations. In these three situations, it will be long term or short term. Situation number one is if it is a depreciable asset. Situation number two, if it is a self-generated asset or self-generated goodwill. Now here I have a problem. Let's assume a situation if you are generating that goodwill, you are Infosys that came into picture in early 80s, and something or some kind of this is happening in the current year. It will near recording the value of goodwill in your books of account because of the implication of this section. You will be treated as your intangible asset will be treated as by default short-term capital asset, and the further implication on account of rate of tax or exemption or deduction provision will applicable as far as short-term capital asset is concerned, which otherwise in the erstwhile law, if this section would have not been there, you could have very well claimed that this could be long-term. The third situation that talks of capital asset, which is short-term capital asset at the time of taxation of the amount under section 45(4). So in the third situation, they are talking of a situation if that capital asset which you are distributing to a partner or member at the time of reconstitution, if that capital asset is short-term, then any double taxation happening under 45(4) on that portion will again be short-term. Then what would be long-term? Simple, as that is there in section 2 income section 2 definition. Here also they have said all other things will be long-term balancing figure. Now the second rule which they have inserted is rule 8B AB. This rule is in fact given to give effect for computation of enhanced cost when you subsequently sell those assets which is still lying with you even after retirement, on which the double tax has already been taken by the department at the time of reconstitution. Why I am using word reconstitution? Because at the time of dissolution, there will not be any double taxation. You will go in the 9B only, because 9B talks of dissolution. 45(4) does not talks of dissolution. Double taxation will only arise a reconstitution and distribution of capital asset. If both conditions satisfied, then 9B and 45(4) both will come into picture. I am not going in great detail as far as 8B is concerned, because if I read, you will not understand. I will explain this with the help of case study, so it will be much clearer. Before going into case study, I will just take through the one chart. This will briefly explain how we are placed now and how we were placed in erstwhile 45(4). This erstwhile 45(4) is as it was applicable till 2020. I have not discussed anything as far as what was introduced by way of a bill, because that was never the law. Now everywhere the taxable entity, even old, new, is formed. In 9B, 45(4) new or old 45(4), it is formed. Second thing is very important. Event of trigger of taxability. In the erstwhile 45(4), it was distribution of capital asset on dissolution or otherwise. Now, distribution was qualified by way of a dissolution or otherwise. What is the meaning of otherwise was subject matter of litigation. Bombay High Court has taken a view that otherwise in its ambit will include retirement also. Madras High Court and other High Court has taken a view, no. There was two view which was going on. There was no certainty. Supreme Court has not settled the issue. So at various jurisdiction, basis the what is the High Court decision applicable, the view was taken by the officer. So here in the old law, both the condition has to be satisfied for taxability or under 45(4). But let's assume a situation if you say dissolution is happening in year 1 and transfer of capital asset is happening in year 3, 4. In which year you will offer to tax? We have seen that kind of litigation in past, and we have successfully able to argue that before the courts, that in such a situation, it will be chargeable to tax in the year of actual distribution of capital asset, be it in year 3 or 4. We have also seen such kind of litigation wherein there is a partial distribution in year 1, partial in year 3, 4. So officer was taking a view, both the conditions satisfied in year 1. So entire value, even if you have given something in year 3, 4, entire value has to be taken in year 2 itself. Again, we argued successfully before the court, no, you have to split. And if you have to split, there could be two kind of situation. Either take entire cost in the year 1, and in the year 2, when you will offer, you will not get any cost, or split the cost as well. That was the erstwhile law. New law says receipt of capital asset or stock in trade or both by partner in connection with dissolution or reconstitution of firm. Now this will create a problem. Your receipt of capital asset or stock in trade has to be in connection. So if I say I receive the cash or stock in trade or asset in year 1 from the firm or LLP, and reconstitution or dissolution is happening in year 2, can you tax me in year 1? To my mind, answer would be no, because whatever you have received is not in connection with this. If we can further say, you received in the year 1, there is a memorandum of understanding that in year 2 I'm going to retire, and therefore it is in connection with this thing. Again, to my mind, though you have received in year 1 by way of a memorandum of understanding that in year 2 you are going to retire, but again your actual happening of retirement or reconstitution or dissolution has not happened. So I don't know whether this thread of in connection with will be satisfied in such situation or not. To my mind, there could be some litigation there. So then there could be a situation that reconstitution or dissolution is happening in year 1, you're getting asset in year 1, there is no problem, you will be taxed. But dissolution and retirement is happening, a dissolution or reconstitution is happening in year 1, and you are getting something in year 2, 3, 4, 5, 6. As it was there in the earlier law also, we were able to take the help of, we were able to argue, and rightly so. In such situation also, you will be charged to tax in year 3, 4, 5, 6. But here, there is one more added layer of protection. He said, because there the word was transfer of capital asset. So once you transfer, there is a trigger event. Now it says receipt of a capital asset or money or stock in trade. So unless otherwise you receive, it will not be charged, even though there is a dissolution or reconstitution happening. What is the meaning of this? Can you say constructive receipt is also received? I retired, I say this is amount, keep it with you. All those controversy I have already discussed in detail in my subsequent slides. I will come to that when I will discuss that slide. I am taking time here because this will create clear some of the doubts, and things will be clear where we are standing now. Now, second point is year of taxability. Again, we have discussed that. So it is received by the partner. When partner receive, it will be, that is the trigger point, but taxable in the hands of firm. In the earlier, there was nothing to do with when partner receive. It was only when you transfer. Once you transfer, everything is now this thing. Even if partner doesn't take anything, entire money is lying with the firm, that is not a criteria. Now, heads of income, earlier there was only capital gain. Now there is a capital gain and business income plus capital gain under 45(4). Here there is a huge controversy to my mind. 9B says capital gain, but that capital gain will go under 45(1). 45(4) says nothing will in 45(1) will come into picture when 45(4) is coming into picture. So even though you want to try a doubly, try to tax a doubly thing, there could be some scope of argument. Quantum of consideration, erstwhile fair market of value of capital asset on the date of transfer, and cost of acquisition will be as per section 48, 49 in respect of capital asset transferred. Now let's assume a situation. Why I'm discussing this? This will be relevant for new also. I am a LLP or a firm. I am developing some property. The partner who is now getting retired from the firm or LLP is getting something in the form of stock in trade, which is constructed area. In the old law, because AO used to take a view, officer used to take a view that the whatever you are saying is nothing but a capital asset, even though you are giving a nomenclature of a stock in trade, it will be regarded as capital asset. The question was, what would be the cost of acquisition? Because for that asset which I am transferring, The cost of acquisition either could be the construction cost or could be the value which I have introduced at the time of admission as a partner, or could be my share of capital in the firm. These three could be possible things. We in our litigation have successfully argued that my capital balance would be the cost of acquisition, and we have also successfully able to argue that from that value I will be able to get an indexation. Why I'm discussing all these things now, they have created whole lot of mess, because when they are talking of a situation of 9B and capital gain computed in 9B, they are in example giving an indexation benefit. But when they talk of section 45(4), they does not talk of indexation, because this 45(4) is similar to my situation, wherein the cost of acquisition is D, which is your capital account in partnership firm. If that is the case, why you are not denying the indexation benefit? And that is the exact point of my point when I say they have gone beyond in the circular. They specifically say to give indexation benefit when you compute 9B capital gain, but they are silent when it comes to the giving capital gain indexation benefit when you compute the capital gain under section 45(4). Whether that silence can be said that you will not get an indexation benefit. If yes, you are going beyond the mandate of section and you are saying something which you could not have said. Now, I have discussed quantum of consideration and cost of acquisition. Now I am going to the next slide. Treatment of loss. Earlier, because capital gain is chargeable to tax, you will get a loss. Now there are two sets of this thing. If a capital gain computed in 9B and there is a loss, you will get a loss. If capital gain computed in 45(4), you will not get a loss. Your loss will be treated as nil. When I was reading this, I think they have not understood the concept of prudence, and they have also mixed themselves with real income theory. When you want to tax something in advance as a double, you are saying double tax in advance, you are taxing me income which has never accrued to me, and you are saying it is your income, and whenever actually it will accrue, I will give the credit of this. This is not what prudence says. Prudence says, if on the present date there is a loss, you give me the loss. You're saying, no, I will not give you the loss, but I will charge you tax. So this is totally opposite to the prudence principle. Again, in this section only, when they compute the 45(4), while computing the 45(4), they say, I will not give the indexation benefit. I will deem your fair market value, and against that, I will say what is your cost of capital, cost of your capital account, your capital account balance, and basis that I will charge you tax. Without understanding and without appreciating this capital gain you are charging for a capital asset. And let's assume a situation, if I am able to prove on today itself that my historical cost of that capital asset, if you give me indexation, which you are anyway going to give me when you compute my actual capital gain when I transfer that asset, I am at a loss situation. Though there is no computation mechanism because I have not transferred that capital asset. But if I prove that asset value is 100, cost is 50, if you give me indexation till today only, and cost comes to 110, and there is a loss, there is no question of taxing an advance amount for which you will give credit to me in future, wherein there will not be any capital gain liability in future. But nevertheless, they have given some formula. Along with that formula, they have given the circular. Circular is binding. This is a mechanical circular. It goes step by step. If you follow, irrespective of, you will never earn a capital gain on that capital asset which is still there with you. You have to pay tax in the present year just because there is a reconstitution and you have given some of the assets to the partner. Now there is an interplay. Again, because I have already discussed this thing. Reduction from the cost, which I have already discussed. Now in reduction from the cost, section 48, Roman 3, this is enacted. They have further increased the scope of 48.3 by way of a circular, which is beneficial thing for depreciable asset. So that has to be also read into this. Cost of capital asset in the hands of recipient partner. Now again, I will take some time here. Cost of capital asset in the hands of recipient partner. You have given me some capital asset. That capital asset on which I have received, but firm has offered to tax. Earlier also, when I was receiving something, firm has offered to tax. Under the general accepted accounting principle, that value I was taking as a cost of asset. And over and above, if I am selling that asset and I'm getting something more to that, I was offering that amount for tax. Now you have changed the entire thing. You have brought all your imagination here, but still this thing you have not clarified. That you are taxing me, taxing the firm on the value of fair market value of asset which you are giving to the partner, but that value will be taken as the cost of acquisition in the hands of partner when partner will transfer. You could have clarified that. Some intelligent officer will say the circular is binding, it is not giving that benefit of the cost. I will take the historical cost, because 49 says in such a situation cost will be cost to the previous owner, and one of the clauses is 49 A Roman 3, which talks of a erstwhile situation before 1987 when everything was exempt. There was no tax, there was no 45(4). They say you can take the cost in the hands of firm as the cost in the hands of partner. Why you have not clarified this? You could have very well clarified why you want associate to go into litigation, but at the same point of time, for all your point, you have clarified everything. For this, we have to come to again the general accepted accounting principle, because I have already offered to tax in the hands of firm, and whatever firm offers to tax in the hands of partner, it is exempt in 10(2). And if it is exempt in 10(2), to the extent of that amount, it will not be chargeable to tax. So that should be my cost of acquisition as far as section 48 is concerned, and over and above only I will be offering the tax. You could have clarified that, America, but that is not there. Now definition and everything we have discussed, CBDT power also we have discussed, so I'm not taking that. Now I am moving to case study. Now, in a situation wherein there is an independent application of section 9B or independent application section 45(4) without any interconnection, there is no dispute. So I am not discussing that situation. In what situation there will be overlap and how the capital gain has to be computed, I am discussing only those situations. So in case study also, we are discussing of those situations. Case study is very symptomatic. Only one land or one capital asset has been given, so that to give a perspective that what is the intention in their mind, and then this ratio and whatever I am discussing can be applied to the case study which department has given in their circular. In the facts of the present case, there are two members. So it actually the case study which is prepared, it is for the firm, but it is equally applicable as far as LLP is concerned. So if I say firm, please understand it as LLP. There are two partners or members, A1, A2 in the firm. They have contributed 5,000 rupees as their initial contribution. They bought one land from this initial contribution of 10,000 rupees. This is long back. Now, in the present year, when there is a dissolution happening, the fair market value of land is 1 lakh rupees. And this land is long-term capital asset because it was held from long time. Now, what would be the tax implication if this land is equally distributed between A1 and A2 on dissolution? Under the erstwhile 45(4), because there is a distribution of capital asset, tax liability would come in the hands of firm. The market value is 1 lakh rupees less the cost 10,000 rupees. It will be taxable at the rate 90,000 rupees. Please come to slide number next slide, wherein I have given that working. So it says 1 lakh rupees. Sorry, I have not given the old working. Old working will be 1 lakh rupees only, 90,000 only. Now under new 9B and 45(4). Now, because in the facts of this case, as I said, there is a dissolution. If there is a dissolution, 45(4) is already out of it, and the capital gain will be chargeable to tax under 9B. Now 9B capital gain is 90,000 rupees, which is chargeable tax in the hands of firm. But where it will be chargeable to tax? 45(4) is not applicable. Now it will go to the tax under 45(1). I have no dispute here, because in such facts of the case, 45(4) is never applicable. So notwithstanding anything contained in 45(1), which is opening para of 45(4), will never come into play. So 45(1) can independently apply in such a situation, and it will be chargeable tax under 45(1). No dispute, no issue. Tax rate, taxability in old and new will remain the same. I am going to the next case study. Now here again there are 3 partners. Each has brought 500 rupees. They have equal profit sharing ratio. Again, in the facts of this case, they have bought the land at 1500 rupees, and the current fair market value of land is 2100 rupees. Now here X retires. So the retirement falls in the reconstitution clause A. One or more partners ceases to be a partner. So there is a reconstitution. So reconstitution is there in 45(4) as well as 9B at both the places. Now what is the next condition? X retires from the firm and his account is settled in cash. Now cash is missing in 9B. 9B only talks of capital asset. Cash is there, money is there in 45(4). So again, in this set of facts, I'm clear that only 45(4) will come into picture, new 45(4), and 9B will not come into picture. So let's go ahead. What is the thing happening here? So the X share is distributed, given to him in a cash by way of cash which is being brought by the remaining partner. So Y and Z brings the cash in the firm, and because the market value of the land in the firm was 2100 rupees and he had 1/3 share, which was 700 rupees. 700 rupees was given in a cash as against 500 rupees of capital balance. What would be the tax implication? Under the old law, there would not have been any tax liability. Why? Because there is no distribution of capital asset. So 45(4) in the hands of firm will not come into picture. In the hands of partner, if he is receiving over and above his capital account balance, it is not chargeable to tax because there is no transfer as held by various tribunal decision and courts, high courts and Supreme Court decision. And also, if you say whether he has got over and above, because just before receiving 700 rupees, the value of asset of the firm has been revalued and his capital account balance was 700 rupees, he got 700 rupees. Even for that logic, there could not be any tax liability in the hands of partner. But this was subject matter of dispute in the old law and department used to challenge this, but court was consistent in saying that you will not be charged. There are one or more, 2 strange decisions in the old law. If I remember correctly, there is one decision of Mumbai Tribunal in case of Vijay Talkies, which says that 45(4) is mischief section. Though it is a deeming section, it is trying to curb something. So just because of giving a capital asset, you have sold the capital asset and given a cash without appreciating. If firm is selling the capital asset, firm is liable to tax and the firm will pay tax on that. And therefore, this is something after tax paid distributed cash, you should not have levied 45(4). They say yes, 45(4) will come to picture. But that was the only decision which I could have come across. Otherwise, this was a consistent position. Now, what will be the tax implication in the new section? As I said, under the new section, 9B will not come into picture because there is no distribution of capital asset. There is only distribution of cash. 45(4) will come into picture. 45(4) has given a formula. Capital gain will be the money received plus fair market value of asset. There is no asset given. So 700 rupees the money received plus 700 less the capital account balance without taking into effect the revaluation on account of any asset or revaluation or in partner's account being credited on account of self-generated asset or goodwill. So 200 rupees which has been credited to partner's capital account will not be taken into account. So partner's capital balance will be 500 rupees and he will be chargeable tax on 200 rupees under the new law. Now this is the thing which they have not contemplated in their memorandum explaining Finance Bill 2021, when their scope was very limited. They wanted to tax only transfer of capital asset. But now when they enacted, they have gone beyond everything. There is no rational, no intention coming from anywhere. But now this 200 rupees, they want to tax under 45(4). Now the asset remains with the partnership firm, which is of book value 1500 rupees and market value 2100 rupees. Partnership firm has paid tax on 200 rupees. But partnership firm has not disposed that asset. That retiring partner only got cash. That partnership remaining partner is brought into the firm. Now here the 48.3 will come into picture, because 48.3 and rule AB. Now I will explain what is rule AB. 8AB says that if the taxes paid under 45.4 is on account of revaluation of capital asset, which is still lying with the partnership firm, to the extent of ratio of increase in the value of asset, in the same proportion that capital gain value will be allocated to each of those assets, and those values should be reduced when you compute the capital gain in the year of transfer. In nutshell, if in the facts of the present case, if there would have been two assets of 750 each, comprising of 1500 rupees, and now their market value is 2100 rupees as against only one asset, now the increase in both the asset is equal. From 750 to it is going into 1050 rupees. So there is an increase of 300 rupees. So we have to see the proportion of increase. So 300 here, 300 there, 600 increase. Proportion is 1:1. In that proportion, you have to distribute the capital gain of 200 rupees. So it will be equal distribution. Both this asset, when you sell in future, as per 48.3, from the sale consideration, this amount will be reduced. What is the implication when I say it is reduced from the sale consideration? The implication is you will never get indexation benefit on this amount. You are charging that amount to tax in the year 1 itself. You are going to reduce this value in year 20 if I sell this in year 20. You are taking tax of that amount in year 1 itself. So in year 20, again, I will reduce this amount. If rather than this, you could have said that this value would be added to your cost. In a way, you could have get the indexation, but no, you have not done so. Here, circular is not coming to picture. This is it there itself in section 48 Roman 3. So I cannot say that circular is going beyond, but yes, I can say circular is going beyond when it comes to depreciable asset. There also they have given the same treatment. I have learned that when there is no particular method of giving benefit has been determined under the Act, the method which is more beneficial to the assessee should be adopted. If it is a depreciable asset, the circular says it should be reduced from the full value of consideration. I would say there is no question of depreciation, indexation, because it is a depreciable asset. But still, if I can get some kind of benefit, I can argue that this could be very well added to the cost, because that is not coming from the statute, that is coming from the circular. Subject to section 9B 4 and 5, which says it is binding on the assessee. Now, before moving into the next let me tell you what I was explaining before going into the case study. If you can go to this previous slide. Now here you are charging 200 rupees tax, which is the cash given by me. And you are saying 200 rupees benefit I will give when you actually transfer this capital asset in the future. What I was trying to explain, the land cost is 1500 rupees. Fair market value is 2100 rupees as on today. Let's assume if I sell this land today and I compute the capital gain, after computing the indexation benefit, because I will get the indexation under normal provision, it is a long term. Suppose my cost of indexation is 2500 rupees. I will be at loss. Even today, you will not be able to charge me tax. Why then? Why you are taking this 200 rupees? There could have been some kind of safeguard to say that if there is some income as on today, then only I will charge this extra amount. Let's suppose the same situation remains in year 2 when actually sells the land. There is a loss. How will you give that benefit? There will be extra loss. And if I am not able to claim that extra loss benefit in the next 8 years against the long-term capital gain which I am earning, that loss will be lapsed. So I am getting a loss by way of paying tax. Why would I get that? Why would I want to have that kind of loss by paying a tax? I don't want to pay tax. But that option is not available. That kind of safeguard is not given. You have to, irrespective of whether on actual basis, even in the year of actual reconstitution, also if there is you can prove that there is no actual capital gain going to happen on the asset which will remain with the firm, still you have to pay a capital gain tax on a dimming basis. With this, I'm moving to the next slide, case study 3. Case study 3 talks of a distribution of a capital asset on retirement. Now here, this is the real case study wherein I have given interplay between 9B and 45.4. So I would request everyone to kindly give attention here, because this is really important and how things will happen as far as actual computation of capital gain is concerned. And there is a firm which has 3 partners, and facts are same as I have given in case study 2. Each partner has brought capital of 500 rupees. The land is valuing 1500 rupees. Their fair market value is 2100 rupees. There is only one capital asset. For the sake of clarity, I have given only one, so that we can understand the concept. Then the same logic I can apply if the facts are getting complicated. Fair market value of now Mr. X, who was earlier also getting retired in case study 2, is also getting retired in here, case study 3. But instead of giving cash, I am giving 1/3 portion of land to him. Now, because I am giving a capital asset on account of retirement, which is nothing but the reconstitution, this will fall within 9B as well as 45.4. 45.4 talks of reconstitution and capital asset and money. 9B talks of reconstitution, dissolution, and capital asset and stock in trade. So this is falling under both the heads. So there, both things will come into picture. So how capital gain will be computed here? Now, I am giving a portion of land which is having a value of book value of 500 rupees and market value is 700 rupees. So under the old law, again, as I explained, there was a controversy whether retirement comes in 45.4 and all those things. But if it is chargeable to tax, it was chargeable to tax in the hands of firm. Now, under the new law, how it will happen? Slide 34. What is the fair market value of capital asset received by the retiring member or partner is 700 rupees. Cost of 1/3 of land, 500 rupees. Now, what is this cost of 1/3 of land? This is cost of land in the hands of partnership firm or LLP, which there is no corresponding section in 9B to say that it will be deemed to be the cost of land, which I have explained earlier. But still, in the example also, they have said that this will be the cost of land. So that cost of land is 500 rupees. Capital gain in the hands of firm will be 200 rupees. So this is the capital gain in the hands of firm. Now, once you compute the 200 rupees capital gain tax under section 9B, now where will this gain go? It will go in 45(1). There is no other section. If we say charging section in section 45 section, there is only one general section, that is section 45(1). All other are specific section. And that general section has been carved out as an exception, and there will be overriding 45(4). So when 45(4) will come into picture, 45(1) will never come into picture. But again, I don't know how they have said that 9B, it will be chargeable to tax in the hands of firm as a capital gain. It will go under 45(1). So some smart advocate or chartered accountant can argue, you cannot tax me 9B because I'm ultimately going to tax under 45(4), and 45(4) say notwithstanding anything contained in 45(1). So there cannot be independent levy of 9B unless otherwise you bring some kind of charging section in 45, which is other than 45(1). Be that as the case may be, we will read the law as it is explained to us in the circular that there will be a double taxation. So 9B, there will be a taxation of 200 rupees. Now, if there is a taxation of capital gain of 200 rupees in the hands of firm, now firm will distribute this profit to all the partners. Now, because the firm has revalued all its share in the entire plot of land, there is a revaluation of 600 rupees from 1500 to 2100 rupees. So 200 rupees, this share of X, which was 1/3, has been credited to his profit and loss account. It's a capital account. So his total balance became 700, against which he got 700 rupees. Closing balance is nil. Now, now comes the 45(4). 45(4) says what? A, B, C, D. A is capital gain, B is value of money, that is nil, C is value of market value of asset, which is 700 rupees. Now comes D, how to compute D. D says capital account balance of the firm at the time of this of the partner in the or member in the LLP at the time of reconstitution, without taking into account the value on account of without taking into account the valuation value of the assets of the firm. Now there is a firm, a partner has already got 200 rupees revaluation, which I have to ignore because I can't take credit of that. But there will be a transfer of profit which firm has earned on 200 rupees, which firm is going to pay tax on that thing. The share of Mr. X will be 1/3, and if we see 1/3 share, it will come to 66 rupees. And that 66 rupees is credited to the capital account of Mr. X, and therefore on a 134 rupees Mr. Firm will pay tax under 45(4). Now what is this 134 rupees? If on a holistic basis you see what firm has earned on revaluation, firm has earned on a revaluation 600 rupees, out of which 200 rupees you have already taxed in the hands of firm under 9B. Now what remains is 400 rupees. Out of 400 rupees, 2 partners are already there in the firm, so they are not going anywhere. Only one left. What was the share of that left, a partner who left in that remaining 400 rupees? Is, if you see, is 1/3, which comes to 134 rupees. That 134 rupees they are charging tax. That 134 rupees is in a way inbuilt in the full value of consideration which you will receive on sending off those remaining assets. And therefore they have come up with 48.3. Whenever you will sell this 134 rupees, I will reduce. So to that extent, there is a double taxation here on 134, but to benefit of that you will get at the time of selling. Again, on 134 you will not get any indexation benefit. With this, I will move to the next case study. Now, before going into the next case study, in the case study 3, I have not taken a situation wherein there will be, what will be the method of computation. If you go to case study 3, method of computation of 66 rupees. How I have computed 66 rupees? There is a 200 rupees gain. What is the share of 1/3 on 200 is 66 rupees. Actually, this could have been the correct way. This is the way I am going to write my X capital account. I am not going to see that on this 200 rupees, which is the gain, there is going to be capital gain tax. So I'm going to reduce that capital gain tax, and balance account amount will only transfer to the capital account. If I do that, the capital gain under 45(4) to that extent will get increased. This is not coming from the anywhere in section 45(4) in 9B, but it is coming from the circular example which department has given. They are saying what you have to distribute to the partner's capital account post tax profit. This is not how I account my books of accounts. This is not how I write my books of account. Therefore, I asked in starting of this presentation, who has doubt? What you are clarifying? You have to clarify only something wherein you cannot give effect to the provisions of this act. This is something you have gone beyond the provisions of the act. This is the second anomaly which I wanted to point out. If you read the example 1 of the department, they categorically said that 200 rupees minus tax, they have taken example of 20% tax. They have not taken surcharge and cess for convenience purpose, and balance amount they have transferred. To my mind, not correct, but again subject to section 9B 4 and 5, which says it is binding on basis. Let's come to the next case study. So I'm going very slow, I know, but after this case study 4, I have listed various instances which could create a problem, but I will not take that. I will sum up this case study in just 3-4 minutes for some completeness sake, and thereafter I will open this forum for questions. And the next thing, before that, I will just give to Anish Bhai, because I have raised one question which I could not get answer. If he has something to add or if he has something to add on any other point which I have discussed, or something which I have said something more than what I could have said, I will invite Anish sir's attention on that, and then I will leave this forum for the questions. The issues which I have listed which could create a problem, there I have given both the views in the presentation, and I will share the presentation which I have already shared with the association to all the participants, so they can see that what could be the fallout of both the views, and basis that they can decide what is the correct view as far as their facts is concerned on a particular issue which could arise in their case. Now I will just summarize case study 4. In the case study 4, here I have given the same example so that there can be continuity in their understanding. But instead of that, I am saying there is a distribution of stock in trade. So once there is a stock in trade comes into picture, 45.4 is already out of it, because 45.4 does not talk of stock in trade. Naturally, because it is sitting under capital gain head, it will come under 9B. 9B, it says if it is a stock in trade, it will be chargeable to tax under profit and gains of business profession. Unlike 9B capital gain, there is no corresponding charge in section in 45 section, because 45.4 overrides 45.1. In business and profession, the general section is good enough to take care of this kind of situation. So there cannot be that kind of argument available. So if there is a stock in trade is given for distribution, earlier we could have argued in erstwhile 45.4 that there is no tax because there is no 45.4 and there is no 28, nothing is chargeable tax. Now there will be a taxation, and taxation of 200 will be under section 28. See, this is the code in itself, and if it is a code in itself and they have given everything under deeming thing, the cost, except cost, full value of consideration, transfer, entity in whose hand it is to be taxed, everything is deemed. To my mind, there could not be any question of importing 43CA, 50C or any other section to substitute something which is not been given in this section. Now with this, I have completed this case study. One last point which was there in my mind, I will just take in 2 minutes, then I will go, I will hand over this to Anish Bhai for his supplements on my point. If I can ask my colleague to come to one of the issues which is very critical, and how the thinking of, come to slide number 42, which is issue 5. I don't know what is the slide there. Issue 5. Revised slide number is maybe different. Yes. Now here I will just take 2 minutes and I will leave that question open, because why I'm taking that here is because the argument or thing which I'm going to say right now is not contemplated or not written here. So I just want to supplement that so that if anyone is reading this, they will be able to appreciate. As I said, section 9B and section 45.4 is code in itself. The issue 5 is talking of capital gain computation under section 45.4 when there is a double taxation and you have to compute the capital account balance, which is clause D in this thing. What if there is a negative balance? If whether you have to take as a nil, whether negative will add on to your thing and you will have to pay tax on that. The argument, both side argument, which I have already given in slide number, subsequent slide, does not takes into account. There is already a special bench decision in case of Simit Securities, which was with respect to section 50B. Though the section and the implication was different, but all the commercial argument to say that how can your cost of acquisition can be negative, how can this mathematical thing can be taken into account, this is not logical, everything is taken into account. And they say when it is a code in itself, you have to don't go by the microscope approach. You have to just apply mechanically, and whatever the result is coming, you have to offer tax on that. With that, I will conclude my presentation and I will give it to Anish Bhai for his concluding remark on my points. And I have raised one query if he has anything to supplement. Thank you so
much. Thank you, Nikhil. Very well summarized in terms of whatever we have on 45.4 and 9B. My personal take on this is this, that if you see right from the days when ICDS came in, the endeavor of the government is to tax income at the earliest point possible. Okay. And if you see how ICDS was developed in a way that you tax income as soon as it arises, but you give deduction of expenditure at the latest possible time. So you advance tax collection to the extent possible. Now, what has happened in this endeavor is that I think the officials have tasted blood, and they have gone, in my view, beyond this concept when they have enacted this 45(4) and 9. Let us understand what is happening when these things happen. Ultimately, where is the money coming from? The money that a retiring partner gets either comes from internal accruals of the firm, or it comes from capital contribution from other partners. Okay. So therefore, what is happening? What is that partner getting? That partner is getting only tax paid money, which is already suffered tax either in the hands of the partnership, or when a partner contributes, or where another partner contributes money to that partnership firm, he is getting the money from there, right? In which case, why would you want to even bring that money into taxation? Law, after considering so many things, after traversing so many years of litigation, came to a particular position. All that was left in dispute was whether an event like a retirement is covered in the expression or otherwise. And, A.N. Naik actually upset the apple cart there. But the whole point is that what is it that you are trying to tax? Why are you trying to tax capital contributions? Look at the ethos of 45(4) versus the ethos of 45(3). 45(3) tells you when I contribute a capital asset into a partnership firm, I will tax. But when will the taxation happen? The taxation will happen actually when there is a realization of that money, right? When the firm sells the capital asset. Now, that was the ethos at that time. Look at the change in ethos today. You don't earn money. Money comes out of capital account, tax paid money. I want to still tax it at the earliest possible. I don't care what happens subsequently. And Nikhil rightly pointed out that in a subsequent year, what is going to happen is I'm not even giving you indexation. I am reducing this from the sale proceeds. I am not even adding it to the cost, the amount on which I have paid tax. Does that make any logical sense? No. I am giving way completely to the definition of transfer, to the concept of transfer. Does that make sense as far as capital gain is concerned? No, it does not. When you legislate with a particular intention in mind, the intention being to collect tax as soon as possible, you will come into anomalies. And these are anomalies, and Nikhil rightly pointed out, why do you need guidelines? You need guidelines because the section itself is drafted in such a confusing manner. Why do you need the confusion? You need the confusion only to collect tax at the first point or at a point where there is no income. I personally think that, this is not in the right spirit. I would believe that the ethos has completely changed from 45(3) to 45(4) and 9B. I would think that these provisions are something which, yes, we will have to live with, but will create one more hotbed of litigation for all of us put together. Because to my mind, these things just do not make logical sense. There is no, I can understand somebody is taking away money, right? You say that, all right, there's a revaluation. The partner takes away more than what he has contributed. But is he not entitled to that? And today or tomorrow, on that revalued balance, is the firm not going to pay tax? Of course, it is going to pay tax, because as far as the firm is concerned, the cost of acquisition in the hands of that firm is not something that it pays to the partner. It is the original cost of the asset that the firm has. So in my view, somewhere I think we've lost the wood for the trees. My sense is that somewhere or the other, we need to relook at these provisions. We need to rationalize what we are trying to do. And we are trying to only make our lives complicated. You look at what is enacted in TDS today, right? Provisions like 194O, 194R, 194S. I'm not sure where we are going, right? As a civilized society, I believe that we must collect tax. There is no doubt. The tax has to be collected in the least painful manner as far as the subjects are concerned. We are collecting tax in a manner where the subjects are getting more and more confused. They are getting more and more pained. As tax professionals, it is getting us good business, and there is no doubt. And it will continue to get us good, opportunities in the future. Point is not that. The point is we are also subjects of this state, right? And as a subject of this state, I have a huge problem with the way in which the tax is getting collected. I would believe that if I were given a choice to represent, I would say look at the ethos of 45.3. Tax me as and when the firm sells the asset. I have no problem. I have got the money. Let there be a mechanism of withholding of certain cash by the firm, and let the firm pay. Let there be some sort of a compulsory deposit that the firm needs to pay, right? Let that deposit earn interest. As and when there is a tax payment, let it get paid from that deposit. If there is no tax payment, let the partner get the money back with his interest. I think all right. Back. No, we're back. I'm sorry.
You are on mute, Anish ji.
Sorry, I said with that, let me end this. Let me open the floor for questions. I think, these are challenging provisions. These are provisions which will continue to, the law on this will continue to evolve as we go along. It will lead to one more hotbed of litigation. As I said, it's a professional opportunity, but as a subject, I am pained at the way the tax is being collected from me. Questions, please.
So now anybody has any question? Otherwise, they can directly ask I can unmute them. If anybody has, they can raise their hand so that I can unmute them.
I think most of the questions in the chat box, Nikhil tells me, are already discussed.
That I'll be taking on to. Before that, there are some questions on the chat box, so let us go by that. So starting from the chat box, can LLP do the business of shares options trading?
Answer is the ROC is not giving permission, right? So the way workaround people do is they write many other objects in the LLP deed. One object is also that of share trading, right? Or buying and selling of shares, and people do it practically. But if you see it in that fashion, the ROC considers this to be a sort of NBFC activity. And therefore, if you write on the face of your LLP deed, the main object of the LLP is to buy and sell shares, then the ROC will not give you permission. They'll say go to the RBI, and the RBI will not give you permission because they'll say that NBFC is only a company. We are not concerned. So you're caught between the deep sea.
So, in case of a retirement where the outgoing partner receives an amount over and above his balance in the books of the partnership firm, say premium, but receives such premium amount directly from a new incoming partner, what is the tax liability on such premium and on whom?
56 to 10. If Because what is the consideration? Unless I'm saying there are two things that can happen. One is he says, I am transferring my share to you, in which case, arguably, there is still a capital asset because a right to receive future profit is capital asset. Okay. And therefore, there will be, in theory, capital gains. We can come and argue Sunil Siddharth Bhai again to say that what is the consideration? We do not know what is it. I'm receiving some money, but what is my cost? Can I say that my cost is only the amount that I have put in? Maybe not, because I have put in effort also. And I'm talking about a working partner. I'm not talking about a non-working partner. A working partner, other than the amount of capital that he puts in, also puts his blood, sweat, and tears into the partnership business. Is that possible to value? The answer is probably no. And therefore, again, this is one hotbed of litigation. If I say no, this is not for a transfer of the partnership interest, then clearly I'm putting myself into the trap of 56(2)(10). So you're damned if you do, you're damned if you don't. We'll have to litigate it out.
So next question is from Mr. Abhay Chajar. For audit purpose, whether capital contribution as per LLP agreement or fixed capital balance plus current capital balance is to be considered. Example, fixed capital contribution is say 20 lakhs and current capital account is say 50 lakhs. Whether such LLP requires to get the audit as per LLP Act done.
My sense is, again, not a tax question, but my sense would be that I would believe yes. I take a very conservative view on these positions because it's just not worth it if you ask me. But strictly not a tax question. But my view is that I would not want to take pangas. Not on audit requirements, no.
So that was all from the chat box. If anybody has any other question, they can directly unmute and ask to the learned speaker. If anybody, I am just finding out if anybody has raised their hand. So Shubham, are you there? By the way?
Yes, I am there. Hello.
Yes. Okay. So I think because the session which you and Mr. Nikhil has delivered does not require much of a question and answer, because the doubts have already been cleared to the extent, because a lot of example case studies were there. So I don't, that leaves no scopes for having a question at the end. So now I would request Shubham
Also,
Khetan.
I think people are tired. People want to go home and, have their dinner. So yes, have a good dinner, everybody. I would think that, again, let me also recognize the effort of my colleague Palak, who is here. She's done a lot of work in preparing the presentation, coordination with the organizers, and changing slides. So thank you, Palak, for all your hard work. And once again, thanks to all of you for a patient hearing. It's always been a pleasure. As I said, I was very happy when I was that with all humility and grace. Thank you very much.
So now I would request Shubham Khetan, who is again an executive committee member of ACAE, to give a vote of thanks to the learned speakers.
So thank you so much, Rahul. I think this was indeed a very enjoyable session for all of us. I'm sure we had a lot of opportunities to learn, and we can see that we had a large group of people who had attended right till the end, and we are getting good response from in the chat box also from a lot of participants. This speaks volumes for the quality of deliberation that we've had, and we've thoroughly been enriched by the knowledge that has been provided by Anish sir. I would like to share the screen for giving Anish sir the e-memento. Rahul, is it visible? Okay, yeah.
Yes,
So
it is visible. Thank you. And thank you very much. Very nice.
Thank you so much, sir. Thank you so much for sparing your valuable time and enriching all of us. I'm sure everyone is really glad to have listened to this session. Thank you so much, sir.
Thank you. And thanks also to Nikhil.
Have it for Mr. Nikhil as well. Yes. So
yeah. We also have a vote of thanks for Mr. Nikhil, who is also from Mumbai, who has also put in a lot of hard work Nikhilji, if I'll just share my screen for you as well. So this is the e-memento which we have prepared for you, and thank you so much once again for giving your valuable time to us and enriching all of us. It was indeed a very wonderful session for all of us. I'm sure everyone in the audience has been very and like appreciative of the kind of knowledge that you've shared to us. Thank you so much, sir, for giving your insights on this subject. With this, I would like to thank everyone who has attended this session and made this a very successful one. And because of the wonderful speakers and because of this one large group of audience that we've had, the session has been very successful for all of us. Thank you so much to everyone. We hereby close the session. Thank you.
Thank you very much.
Thank you, Anish ji. Thank you, Nikhil ji. Thank you, Shubham. So we can just end the meeting.